Okay. Okay. Good morning, everyone. Uh, Welcome back to our last session on Ind AS 116 that deals with leases. Okay. So we have a lot of things on hand today. Will be a little fast. Where there is concepts, I will address it. But where it is pure computation, I have prepared a working. So I will be sharing the Excel workings with you, but for today, we will not go into lot of computations because understanding the concept is more important. Computation is a repetitive aspect as far as leases are concerned, which you will understand as we move ahead. Okay. So with that, let us just have a quick recap of what we were looking at in the last class. We were checking lease payments. Okay. And we had completed this definition. When I talk about lease payments, it is specifically between the lessor and the lessee, the payment made by the lessee to the lessor in exchange for the right to use the underlying asset. So what would be normally included? The first thing is the fixed payments. Fixed means not exactly the same payment, but it should be determinable. And this will go in your lease liability computation. Okay. It will also include something known as in-substance fixed payments. Apparently, it appears the payments are not determinable, but if you look into the contract carefully, there is a fixed component. So that is also going to be a part of your fixed payments. Then it will also have a reduction of lease incentives after commencement. Okay, after commencement of the lease, any lease incentives which are paid, that will go towards my what you can say a lease liability. It will be reduced while computing my lease liability. What is lease incentive? A benefit that is paid by the lessor to the lessee. Normally lease payment is lessee to lessor, but in the case of a lease incentive, it is from lessor to lessee. So that is an abnormal thing, but you have some such transactions, so you cannot take it as other income. Rather, it will be a reduction of liability provided the lease incentive is paid after the date of commencement. Okay, so that is lease incentives. Then we discussed variable lease payments, payments which are not determinable at the commencement date. So these could be divided into two parts: variable lease payments not linked to an index or a rate. For example, payments linked to revenue, payment linked to usage, payment linked to production. I do not know how much I will produce. So therefore, you cannot estimate with certainty what is the amount, and the standard does not allow you to estimate. So what does Ind AS 116 say? When it is incurred, when you are going to pay based on the variable lease payment criteria, when the criteria is fulfilled, the amount that you are going to pay, that amount you will straight away take it to your profit and loss as variable lease payments as and when incurred. The next category of variable lease payment is what is linked to an index or a rate, because this reflects a increase or changes in the lease payments on account of passage of time. When I talk about index or rate, it could be consumer price index, wholesale price index, any index, even Sensex, Nifty, or rates you talk, it could be LIBOR, it could be RBI rate, it could be any rate. Now, these rates are a true representation of the passage of time, and therefore, variable lease payments linked to an index or rate will form a part of the what you can say will form a part of the lease liability. And how are we going to determine? Because these rates and indices keep fluctuating. So the standard says on the commencement date, whatever is the rate or the index, you will take that and estimate the lease liability. Subsequently, there may be changes. There will be changes in indices or in the rates, but you will give effect to those changes only when the cash flows undergo a change. Only when cash flows undergo a change. So this is variable lease payments. Then we checked up exercise price of an option. If the lessee is likely to exercise, include it in lease payments. Payments of penalties for terminating the lease. If you believe you will terminate the lease, then you have to pay a penalty. So include that penalty in the lease payments. And finally, payments expected to be made under a residual value guarantee by the lessee. So these lease payments will go towards determining the lease liability, specifically what I have told, specifically the lease incentive after commencement. Okay, because there is a lease incentive which could be paid before commencement, the liability does not exist at that point of time. So that will go as an advance which you have paid, which will be added to the ROU asset subsequently. Okay, so this is what we have already done. And now we move on to the next set of important definitions, that is initial direct cost and discount rate. Not so important, but it has its applications in the questions that we will be doing today. Okay. So what do you mean by initial direct cost? IDC, these are the costs. These are like incremental cost. Matlab, if I enter into a lease, I will be incurring these costs. If I do not enter into a lease, I will not incur these costs. Okay, so these are incremental costs for the lease arrangement. That means if the lease comes into existence, then I will incur it. For example, brokerage, legal fees for the execution of the lease, payments to the tenants for moving out, etc. These will be incurred only if the lease is there. If lease is not there, whom you will pay brokerage? Whom will you pay legal fees for execution? You will not pay anyone. Okay, so therefore you are going to have incremental costs of obtaining a lease. Apart from this, there are some cases where you will incur a cost regardless of whether you get a lease or not. For example, traveling, legal fees for services prior to execution of lease, advertising, surveys, whatever you are going to do, regardless, there may be tender fees for a lease. Now, whether you get it or don't get it, you have to pay the tender fees. So therefore, these are all not going to be initial direct costs, and therefore they are excluded from the purview of IDC. A fairly simple definition. Okay, fairly simple definition. What is the implication? We will see when we start to solve the problems today. Okay, and finally, we start with something known as your discount rate. See, ultimately, when I talk about a lease asset and a lease liability, the lease liability is the present value of the lease payments. So what do you mean by present value? You know that in future you are going to pay. So therefore discount it to present value. So you need to take into consideration a discount rate. So now when I talk about discount rate, it is this particular point which we are now going to discuss. Okay, so the next point is discount rate. Now, discount rate, what is it going to be? What will be my discount rate? Okay, so ideally the standard says the discount rate should be the rate implicit in the lease. The rate implicit in the lease. So this is your ideal situation. Ideally, it should be the rate implicit in the lease. Rate implicit in the lease means what? That is nothing but the internal rate of return. Whose internal rate of return? The one who is getting the lease payments. That means the lessor's lease payment. So IRR of the lessor. So ideal situation is the IRR of the lessor should be the discount rate. But the lessee will have a problem. The lessee will say, how will I know what is the IRR of the lessor? How will I know what is the IRR of the lessor? That is not something which the lessor will phone and tell me that, chalo, this is the IRR, apply this discount rate. So for the purpose of this discount rate, normally your lessors will be categorized into two types. One is manufacturer or dealer lessor. Manufacturer / dealer lessor, and the other is your pure lessor. The other is your pure lessor. Now, in the case of a manufacturer or dealer lessor, this is like you take, for example, Volkswagen. Okay, you take, for example, a company like Volkswagen. Now, Volkswagen, what does it do? It manufactures cars. It manufactures cars, plus there is a Volkswagen financing arrangement. there is a Volkswagen financing arrangement. So therefore, what do these entities do? These entities produce the vehicles, they maintain the stock, they sell the goods like a normal trader, but additionally, they are also giving financing services. Take, for example, aircraft companies like Airbus or Boeing. What do these entities do? These entities manufacture also, and they give it on lease also. So now it is extremely difficult in this case for the lessee to identify what is the IRR of Volkswagen, what is the IRR of Airbus. How can he identify? There is a profit markup which is included when the goods are sold. There is a financing component which is included when the goods are sold. So therefore, it is very, very difficult to identify the IRR of the lessor by the lessee. It is practically not possible, especially in case of manufacturer or dealer lessor. On the other hand, when you talk about pure lessor, take for example any financial institution that gives leasing and financing services. I'm not talking specifically about bank loans. Okay. I'm talking about leasing and financial services. So in the case of leasing and financial services, how the transactions happen? The financial institution, what does it do? It will take, first is you are the lessee. You go to the financial institution and tell them, I want to buy a vehicle, for example. So what the financial institution will do, the financial institution will go to the manufacturer. The financial institution goes to the manufacturer or the showroom, whatever it is, okay, or even the showroom, okay. And what does this financial institution do? The financial institution, this is not a bank. Bank gives you a loan. This is not a loan. This is a leasing arrangement. So the financial institution will make the payment to the manufacturer or the showroom. So it makes a payment. That is, what do you mean by payment? This is the present value of cash outflows. Are you able to identify it? Yes. So once the present value of cash outflows are determined, the financial institution will get the vehicle in its name. The financial institution will get the invoice in its name. And then what the financial institution does is, it will give the vehicle on lease, or what you call as hire purchase. Both are one similar transactions, on lease or hire purchase. Typically, it will be a hire purchase arrangement. So in a hire purchase arrangement, you will be having something known as a down payment plus something known as a installment. So these you go on paying. So now look from the perspective of the lessee. He knows the following things. He knows present value of cash outflow of lessor. Sir, usko kaise malum? How will you know? He knows the invoice. No, he has seen the invoice, because how will he otherwise agree how much is to be paid? So he knows the invoice. He knows the invoice price to the financial institution. Let us assume that it is 12 lakh rupees. So present value of cash outflow of lessor is 12 lakhs. And this is known to the lessee. Okay. At the same time, once the lessor and lessee come together for an agreement, the lessee has to pay something to the lessor, correct? So therefore, lessee will know what he's going to pay, what are the installments he's paying, at what intervals or at what duration or over what period of time is he going to pay. So the present value of cash inflow of lessor. Does he know this? Yes. Does he know this? Yes. So in our example, I'm just making this up. Suppose it is 1 second. Yeah, 75,000 per annum for 20 years. 75,000 per annum for 20 years. Okay. So now today, this is not present value. This is just cash inflow. Sorry. cash inflow of lessor, 75,000 per annum for a period of 20 years. Okay. So now what does the lessee know? The present value of cash outflow of lessor he knows, which is 12 lakh rupees. The cash inflow of lessor he knows, which is 75,000 per annum for 20 years. So therefore, what is IRR? Ultimately, IRR is the rate which equates the present value of cash outflow with the present value of cash inflow. So that rate can be easily determined by the lessee because he knows each and every cash flow of the lessor relating to this transaction. And therefore, in this case only in this case, you can identify what will be the IRR of the lessor. You can identify what will be the IRR of the lessor. However, if you move ahead, one second, what happened to this? Just a minute. Yeah. If you move ahead, consider the case of a hire purchase arrangement. Consider the case of a hire purchase arrangement, or not a hire purchase. Let us consider the case of a lease arrangement. Let us consider the case of a lease arrangement where the useful life of vehicle is 8 years. Useful life of vehicle is say 8 years. Lease period is 5 years. Lease period is 5 years. Lessee बोलता है, I do not want the vehicle. Okay, so after 5 years, I will return the vehicle back to the lessor. Okay, so there is no purchase option. He's not interested. He will not buy. So for him, the lease period is 5 years. Now pay attention. Now this is a lease arrangement that is there. Now from the perspective of the lessor, what is going to happen? First thing is, he will buy the vehicle. The lessor will buy the vehicle. So present value of cash outflows is there. But will this vehicle's present value, that is, will the lessor share this invoice price with the lessee? Answer is no, because ultimately vehicle is going to revert back to the lessor at the end of 5 years. So therefore, in this case, invoice price not shared with lessee. Invoice price is not shared with the lessee. So you are not able to identify what is going to be the fair value of the asset. You are not going to identify that. I do not even know. I cannot even imagine how much he has paid. Acha. Now, does the lessee know how much lease rents he has to pay? Yes. So cash inflows for 5-year lease period. Cash inflow for 5-year lease period is what the lessee will come to know. Now, at the end of 5 years, the vehicle goes back to the lessor. What are the cash inflows for years 6, 7, and 8? That is the cash inflows after year 5. What is it? Do you think the lessee is in a position to estimate? This is cash inflows of the lessor after the asset reverts back to him. Do you think the lessee is in a position to identify this? He is not in a position. In effect, what is this year 6, 7, and 8 cash inflows? This is nothing but unguaranteed residual value. You can take it as that kind. Okay, it is nothing but unguaranteed residual value. Remaining lifespan is 3 years. Over that 3 years, what are the inflows that will come to the lessor is something which is not guaranteed by the lessee. The lessee is going to guarantee only the lease payments plus any residual value guarantee within the lease period. Once the lease period is over, the lessee will say, who are you to the lessor? Okay, that is how the transaction is going to be. So therefore, the lessee is not in a position to identify what is the present value of cash outflow, because invoice price will not be shared. He is not able to identify what is going to be the unguaranteed residual value, because that is a cash inflow for the lessor. And we know that IRR is nothing but the rates are quite large in number, and as a result, the IRR of the lessor is not determinable by the lessee. And therefore, we need a rate, right? We ultimately need a rate to find the present value. And that is why, what does the standard tell you? The standard gives you an option. First preference, if it is determinable, is the interest rate implicit in the lease, that is the lessor's IRR. However, if this cannot be determined, then what are you going to take? You are going to take the lessee's incremental borrowing rate. So, in absence of IRR of the lessor, you are going to take incremental borrowing rate. You are going to take incremental borrowing rate of lessee. Acha, why are we going to take the incremental borrowing rate of lessee, and why not cost of capital, which is what you know, no, WACC, weighted average cost of capital? Why don't we take WACC? Why we have to take borrowing rate? This is because Ind AS 116 presumes that, and logically so, that if you would not have taken the asset on lease, you would have borrowed it. Okay, that is the presumption. If the asset is not taken on lease, you would have gone to the bank, taken a loan and purchased the asset. That is why we take incremental borrowing rate. If I had the money, I would have gone ahead and purchased the asset myself. Why would I take a lease if I had the money to acquire the asset? Why would I take a lease? And that is why, if I had to acquire the asset myself, I would not take a lease, and that is why weighted average cost of capital cannot be taken as your rate. So the standard believes that a lease is an alternative for borrow and buy. Okay, lease is an alternative for borrow and buy, and that is why in the absence of the IRR of the lessor, you are going to take the incremental borrowing rate of the lessee. This will always be known to the lessee. This rate will always be known to the lessee, and therefore you will take this rate to do your accounting. Okay. Lessor's IRR can be calculated as the rate at which present value of cash flows of the lessor, which is fair value plus the IDC, initial direct cost, is equal to present value of cash inflows, which is lease payments plus the unguaranteed residual value. So this is what is your discussion on the discount rate. Okay, this is what is your discussion on discount rate. Okay, now the first time Ind AS 116 was introduced, it was a very radical change that came into existence. Why do I call it as a radical change? Because up till Ind AS 116, that is, you talk AS 19 or Ind AS 17, and those periods when those accounting standards were in force, you had the concept of a finance lease, you had the concept of a operating lease. Operating lease hota, the lessee would record the lease rent. Finance lease hota, he would do the lease liability, lease asset accounting. When Ind AS 116 was introduced, and we discussed this right in the first lecture, why is Ind AS 116 better? Because it enhances comparability. It mandates recognition of an ROU asset and a lease liability, whatever be your lease term, whatever be your lease term. So this shift was a very, very radical shift. Okay. But what do you mean again IRR, Mahinder? मेरे को समझ में नहीं आया. IRR नहीं है तो you take the incremental borrowing rate. That's it. Okay. IRR again का समझ में नहीं आया, बता देना क्या है. ठीक है. Let me know what it is. Okay. But in India or even elsewhere, you are having very short lease terms also. Okay. Lease term up to 12 months. Now for a lease term up to 12 months, identifying the discount rate, doing the discounting, calculating the ROU asset, calculating the lease liability, doing the amortization of finance cost, depreciating the ROU asset. Ultimately, it starts to hit one of the items in the conceptual framework, which is cost required to give a true and fair view as compared to the benefits that are going to arise out of it, So therefore, the standard setters try to develop a balance between going for the full-fledged applicability of Ind AS 116 for leases. This is from the perspective of the lessee. Or you go for certain exemptions where if you avail those exemptions, then you can straight away take the lease rentals to your profit and loss account. There is no need to recognize ROU asset. Neither is there a need to recognize a lease liability. So what are those optional exemptions? This is purely for convenience, purely for meeting the cost benefit criteria. See, whenever a lessee has to determine the discount rate, determine the fair value, determine what you can say, do the calculation, amortize, determine the useful life. All these things have a particular cost attached to that. Now, if you are achieving a big thing, by giving this picture, go ahead. But in the case of a lease which is less than 12 months from commencement date without a purchase right, what are you going to depreciate? Are you going to depreciate an asset? Sir, uska life is less than 12 months. In the normal case, we would take it to the P&L. It's not a capex. Would you really recognize a financial liability over less than 12 months? Not really. I have to pay it means I might as well take it as the payment as well as the depreciation, might as well skip it off entirely. And whatever payment I'm going to make, I will take that as an expense. And that also gives a true and fair view. That also ultimately gives a true and fair view. We will look in the question that we are going to solve today. But ultimately, what I'm trying to tell is it's not going to make even a single paise ka difference when you avail the optional exemption here. And therefore, we go ahead and avail these optional exemptions. First case, a short-term lease, that is a lease term less than 12 months from the commencement date with no purchase option. So from commencement date, no purchase option, lease term less than 12 months. What are you going to do? You are going to recognize the lease as an expense. You are going to recognize the lease as an expense straight away. No ROU asset or liability. The next one is lease of low value items. Lease of low value items. What do you mean by low value items? Is not specifically defined in the standard. What you mean by low value items is not specifically defined in the standards. But when we talk about low value items, the following cannot be treated as a low value item. This is what is given. Assets which are highly interrelated or interdependent with other assets. For example, tire is highly interrelated with a car. So hypothetically, if you take tires on lease and car is already what you are having, you cannot say that I will apply operating, I will expense out the tire lease to the P&L because it is highly interrelated with the car. But if you take a laptop, if you take a cell phone, it is generally independent. Okay, so generally for these items like a cell phone or a laptop, you can straight away expense it to the P&L. And the next one is head leases. Head leases means what? Lease to a lessee and lessee further subleases it. So in the case of low value items, you cannot take the benefit provided it is a head lease sublease kind of arrangement. Now, how are you going to avail these exemptions? In the case of short-term lease where the period is below 12 months, the choice is to be exercised for a class of underlying assets and not lease by lease That means furniture, suppose you are taking a furnished accommodation less than 12 months. Then for the furniture fixtures that you have taken on lease, you can choose to apply the exemption criteria. Whereas for the building that you have taken on lease, you can choose to apply the ROU asset recognition criteria for building. So it will be on a class by class basis and not on a lease by lease basis. Okay, it will be on a class by class basis. Whereas in the case of low value items, the choice needs to be taken on a lease by lease basis. Matlab each and every item you will have to decide whether I want to take this on a lease or whether should I show it as a lease expense or should I show it as an ROU asset and a lease liability. Okay, so typically, for example, you have these what you can say computers which are taken on leases. Okay, you have many entities which do that. Now the top end management, they get the most expensive models, they get the most what you can say fastest processor and the best operating systems, the best hardware, the best antivirus. Everything is superior for them. Whereas for the actual middle level and below staff, you are giving them reasonably normal laptops, not very high end laptops. So now class of assets is the laptop. But now for the laptops which are given to the top level management, you can choose to apply ROU asset lease liability accounting. Whereas for the laptops which are given to the mid-level management and below, you can choose to apply the operating expense criteria. That means you take it as an optional exemption and you will recognize it as a lease expense in the P&L. So what is the exemption? If the entity chooses to avail the exemption, lease payments would be directly recognized as rental expenses in the P&L. Matlab, there is not going to be any ROU asset and depreciation, lease liability and finance cost, either on a straight line basis or any other systematic basis if available. And this exemption is to be availed at the commencement date. This exemption is to be availed at the commencement date. Ab commencement date ke baad you cannot avail it. Okay, so once you have crossed the commencement date, you cannot change the assumptions that you have made on the exemption on the commencement date. You cannot change what you have chosen subsequently. Okay, so with this background, let us come to some quick questions. Illustration 1 that deals with a short-term lease. Scenario A, a lessee enters into a lease with a 9-month non-cancelable term. Okay, so there is a non-cancelable term of 9 months with an option to extend the lease for 4 months. So if I have to put it on a timeline, I am having 9 months non-cancelable plus 4 months extension. The lease does not have a purchase option. At the lease commencement date, the lessee is reasonably certain to exercise the extension option because the monthly lease payments during the extension period are significantly below the market rates. Okay. Whether the lessee can take a short-term exemption in accordance with Ind AS 116, well, 9 plus 4. Is there an economic incentive for the lessee to exercise the extension? Yes. And that is what the lessee also has thought. So therefore, for the lessee, the lease term is now going to be 13 months. The lease term is going to be 13 months. And so can he take the example, can he take the case of a short-term exemption? Answer is no, he cannot. No, he cannot. Why? Because it is extending 12 months. It is extending 12 months. And assuming that it is not a low value item, you are not in a position to account for it as a short-term lease. You are not in a position to account for it as a short-term lease. Coming on to scenario B, same facts as scenario A, except that at the lease commencement date, lessee is not reasonably certain. Lessee is not reasonably certain to exercise the extension option. Matlab, on the date of commencement, I do not know whether I will exercise. I will not know whether I have to exercise it or not. And therefore, in such a case, for you, the lease term is going to be only a period of 9 months. For you, the lease is going to be only a period of 9 months. And that is why, can you avail the exemption? Answer is yes, you can avail the exemption. And when you avail the exemption, you will take it as an expense. Okay, because the monthly lease payments during the optional extension period are at what the lessee expects to be the market rates. No other factors that would make exercise of the renewal option reasonably certain. So will your answer be different in this case? Well, yes, you can opt for the exemption, in which case it will go as an expense in the P&L. Okay. So now we have certain questions. Sheena Jain has asked, it means that the laptop can't be taken into an exemption option. No, that is not how you are going to view it. Okay. I think you are drawing this query from the fact that I spoke about the directors and the lower staff. Probably. So directors laptops, if you choose not to avail the exemption, you can show directors laptops, top executives laptops as ROU asset and lease liability. Whereas the management and the middle level management and lower levels, you can take the laptops on lease by availing the exemption and treating those lease payments as expenses in the P&L. Okay. So for low value items like laptops, mobiles, etc., what are you going to do is you will have to check. You will have to check on a lease by lease basis, not on a class by class basis. Okay. Whereas in the case of short term lease, you will have to apply the exemption on a class by class basis. You will have to apply on a class by class basis. Okay. So these are two different ways of availing the optional exemptions. These are two different ways of availing the optional exemption. All right. So all right. So when we talk about low value items, what do you mean by low value items? Low value items means it is, when do you assess it to be a low value item? Suppose you buy a second hand car which is already used for 10 years and now the value of that is very less. Do you think that is a low value item? No. You will have to determine whether it is a low value item depending on when the asset was new, what is going to be the fair value of that. Suppose you bought a car today, a second hand car, you cannot take that second hand car's lease rent as a determinable factor of it being a low value item. You will have to look at what is the original value of the vehicle when it was new, the original fair value for a new vehicle, and accordingly you will have to decide whether it is a low value item or not. That is something which you will have to keep in mind. Okay, so this takes care of optional exemptions. Kuch nahi, bahut simple hai, nothing complicated in that. Okay, so now coming to the next important part, and something which we are all probably waiting for right from commencement of this standard is, sir, what are the journal entries, when they will be, how to recognize, how to calculate? This is something which we will now be focusing on. Okay, so first thing is accounting in the books of the lessee. Two cases. the lessee can avail the optional exemption, which we just now discussed, in which case it is going to be rent expense account debit to bank, and rent expense goes to the P&L. In all other cases where you have not availed the exemption or where you are not eligible for exemption, you will pass the entry ROU asset account debit to lease liability. ROU asset account debit to lease liability. So how am I going to recognize the lease liability? How am I going to calculate? So lease liability is measured as present value. So present value using what? A discount rate. Which discount rate? We've already discussed. Two options: IRR of lessor. If that is not available, incremental borrowing rate of the lessee. So present value of all future lease payments. What do you talk about lease payments? The table that we studied, that is fixed payments including in substance lease payments minus any lease incentives after commencement date, okay, to be made during the lease term, that is after commencement. Okay, after commencement. Okay, so fixed payments minus lease incentives, this is what is the second part. Then after that you will come to what? You will come to variable payments which are linked to an index or a rate. Not linked to index or a rate will not go in your lease liability computation. It will go straight away to your profit and loss account. Then present value of what you can say, any residual value guarantee given by the lessee. Then if you are exercising the purchase option, then what you are going to pay under the purchase option, you will include that also. And finally, if you are exercising the termination option, any penalty that you are going to pay to exercise the termination option. All these things are what go in your lease payments, and ultimately they flow in your lease liability, and ultimately it flows in your lease liability by discounting it at the IRR of lessor, or if that is not available, at the what you can say, at the incremental borrowing rate of the lessee. Okay, discounted at the interest rate implicit in the lease. So the 3 to 3.5 hour class which I have taken so far was to make us understand all these things. Okay, so today we are in a position to understand and appreciate what do I mean by lease payments, what do I mean by lease term, what do I mean by discounted at the interest rate. All these things today, why I am able to understand, because we spent considerable time on understanding this. Subsequently, the lease liability will undergo a change on account of interest, obviously, lease payments, naturally, impact of reassessment and lease modification. We will be going through that today. Subsequent accounting for lease liability would be similar to accounting for financial liabilities on an amortized cost basis. Okay, that means lease liability plus interest minus repayment closing. Okay, so this is something that you are going to do on an annual basis. So this is the first note, that is measurement of lease liability. Now lease liability, correspondingly you should have a debit. That debit goes to your ROU asset typically. So how are you going to measure the ROU asset? Initial measurement will be at cost. So what are you going to have in the value of your ROU asset? It will include, first thing is initial lease liability. So when I say credit, that means the lease liability account is going to be credited. So the entry will be ROU asset account debit to lease liability account. Yes. Then you will add any payments made before the commencement date. This is not a lease incentive, mind you. This is a payment made by the lessee to the lessor. Suppose the lease that you are looking at is a very attractive lease, and therefore the lessor thinks, let me take benefit of the attractiveness of my property, and therefore he makes the lessees to upfront pay a particular sum. Okay. Now this upfront fee is a payment that is made before the commencement date. It is a payment made before the commencement date, and therefore liability to tha hi nahi na, there was no liability at that point of time. So how can you debit the liability? So what are you going to debit? You are going to debit the asset only. You are going to debit the asset. So payments made before the commencement date, this is also between the lessor and lessee. You will debit it to the ROU asset. Okay. What will be the credit impact of this? Well, this will go to the bank account. This will go to the bank account. Next one, less lease incentives received before the commencement date. I told you after is adjusted in the lease liability. Before is going to come here. Okay. So credit, I have written as bank negative because that means bank is going to get debited here. Okay. Next one is initial direct costs incurred by lessee. It is not a transaction between lessee and lessor. It is a transaction between a lessee and a third party. And this is ultimately crediting the bank, and that also gets capitalized in the ROU asset. It's a direct cost. The next one is present value of site restoration decommissioning obligations between lessee and third party. So this is going to create a provision for you. Okay, so your initial ROU asset is the sum total of all these things, and the journal entry is reflected as ROU asset account debit to lease liability account to bank net. What do I mean by net? Well, this is 1, this is 2, this is 3. Okay, so 1 plus 3 minus 2. Okay, so that gives you net. And finally, to provision for site restoration. Okay, so all these items are coming in this journal entry, and they all ultimately go into your rows, ROU asset account. They ultimately go into your ROU asset account. Any doubt so far? Any doubt so far? Lease liability accounting, first part, and ROU asset, second part. Any difficulties? Please tell me. Please tell me. Any difficulty so far? We'll look at the questions, don't worry. But so far, have you understood the first two notes? Today, nobody is there. Srinidhi wished. Sheena Jain is there. Vidula, are you there? Mahinder is there. Ayush, are you there? Then who else? और कौन रहता था हमारे lectures में? Sheena is there. Mahinder is there. Priya Garg, are you there? Mahinder. All so far, is it okay? Sir, I didn't understand what is the exemption. Exemption means what? Whatever lease rent you are paying, you take that to the profit and loss account. Normally, what does the Ind AS require you to do? It requires you to recognize ROU asset as well as a lease liability. What are you going to do with the ROU asset? You will show it as an asset, depreciate it over the lease term. What are you going to do with lease liability? You will do financial liability type of accounting. Matlab lease liability, add interest, less payment of lease rent, closing. Do that for every year over the lease term, ultimately until the value becomes 0. This is what is the normal accounting that you would do in the books of the lessee. However, for those two cases, that is where the lease tenure is less than 12 months, or you take the other way, that is, it is a low value item. Then in these two cases, if you avail the exemption, whatever lease rent you pay, you straight away take that to the P&L. So that is your exemption. Okay, there is no hassle of you to calculate ROU asset, no hassle to calculate lease liability, no hassle for depreciation, no hassle for finance cost, amortization of financial liability. All these things do not exist. All these things do not exist. Okay, so that is your exemption. Okay, so that takes care of note 1 and note 2. Note 2, continuing, your ROU asset. Subsequently, how are you going to measure? Well, initial cost, whatever was there, less you will charge the depreciation over the lease term, and less any impairment, which is Ind AS 36. That gives you the carrying amount. After that, if there is any reassessment or modification, which we are going to do it, you will adjust that in the ROU asset. So that gives you the adjusted carrying value. That gives you the adjusted carrying value. Then next you are having depreciation of ROU asset will generally be over the lease term. Naturally, if there is a purchase option which is expected to be exercised, then depreciate over the entire useful life. Depreciate over the entire useful life. And that is why in such cases, ROU asset would be depreciated. Kya likha hai? Would be depreciated over the entire useful life. Okay. The above treatment of depreciating ROU asset over the entire useful life would also apply for leases in perpetuity. Many times it may so happen that a parent gives an asset to a subsidiary on lease, and then the parent tells, you just go on giving me the lease rent. Mereko, I don't need the asset back, and you keep the asset with you forever. Matlab, until you are alive and solvent, it's a company. Okay. Jab tak tum ho, until you are alive, you keep this asset. So therefore, this is a lease in perpetuity. Perpetuity means what? There is no lease term only. That means jab tak tum raho, until you are alive or until this asset is alive, you use it. So therefore, in that case also, you will depreciate the asset over the entire useful life. Over the entire useful life. Okay, so that takes care of ROU asset. And now with this background, let us finally come to certain calculations that we will have to work out. Let us come to some calculations that we will have to work out. Now, what I have done is, the calculations are a monotonous part. Okay, so have a calculator with you. Do the workings on the calculator. Don't write much because this is more about concepts. Okay. I will be sharing the Excel file which I have prepared. By the by, I have already shared this presentation in totality with you. So I hope you can download it for your reference. And whatever calculations are there, I have tried to, put it in an Excel file so that tomorrow when you revise it, you look at the Excel file to know what the workings are there. Now, my Excel file and the solutions given in the Institute study module are slightly different. I'll tell you why, because of rounding off. Okay. I have not rounded off because I want you to see the total impact of the lease asset, lease liability over the lease term. I want you guys to see the impact, and that is why I decided not to go in for rounding off. Okay, so what difference rahega, and the differences will start appearing to be 2,000, 5,000 rupees also, where the lease term, lease rentals are lakhs of rupees. So ignore that rounding off. Otherwise, it's a plain simple problem. Okay, so I'll share that Excel file with you. For today, just be familiar with the calculations, but don't proceed to solve the entire problem. We don't need that at this stage. Okay, we don't need that at this stage. Okay, so now coming to illustration number 27. Entity L enters into a lease for 10 years. Okay, so the lease term is 10 years with a single lease payment payable at the beginning of each year. Beginning of each year means year 1 I will pay today. So the discounting factor is year 0, which is 1.0000. It is at the beginning. At the beginning of year 2 means discounting factor will apply for the first year. At the beginning of year 3 means discounting factor will apply for the second year, so on and so forth. The initial lease payment is rupees 1 lakh. The initial lease payment is rupees 1 lakh. Lease payments will increase by the rate of LIBOR each year. Tell me quickly, is this a variable lease rent or is it a fixed lease rent? Okay, come on, I want your answers now, quick. Don't look at the study module, don't look at anything else, just look at this question and tell me, the lease payments will increase by the rate of LIBOR each year. Tell me, is it a fixed lease payment? Is it a variable lease payment? If it is a variable lease payment, is it linked to a rate or is it other than linked to a rate? And what are you going to do? Will you expense it to the P&L or will you take it in your lease liability calculations? Just look at this and then give me the answer. I'm waiting for your answers. Okay. It is a variable lease payment. Srinidhi has answered. Go ahead and give me the other answers, Srinidhi. Okay, is it linked to a rate or is it other than linked to a rate? And what are you going to do with it? Will you take it to the P&L or will you include it in the lease liability computation? Others also, please chip in with your answers. Mahinder, Vidula, give me your answers. Okay, give me your answers. I take it that if you write variable, you know the treatment, because it may be a pain sometimes to type everything. Okay, variable lease payment which is linked to a rate. Priyagar, good. So you guys are able to at least correlate to what we have already studied. So this is a variable lease payment which is linked to a rate. In this case, it is the LIBOR, and therefore what 116 says, this variable lease payment, because it is linked to a rate, it reflects passage of time, and that is why it will go and sit in your lease liability. But sir, LIBOR keeps on varying every point of time, so therefore what standard tells, at the initial date you will do the calculation taking the LIBOR on the date of commencement. Is it given to you? Yes. At the date of commencement of the lease, LIBOR is 2%. So you will take this 2% and calculate your cash flows over the entire lease term. In future, whenever your cash flows change in accordance with the LIBOR that is present at that point of time, then you will reassess your payments. And accordingly reassess the liability, reassess the ROU asset also. Vidula, linked to a rate, that is right. But will it go to P&L? No, it won't go to the P&L. It will form a part of lease liability. Priya is saying forms a part of lease liability and corresponding ROU asset. Absolutely right. Vidula, if variable lease payment is not linked to a rate or an index, like for example linked to sale, like for example linked to performance, linked to usage, linked to production, then it will go to the P&L. Here it is linked to a rate which you correctly identified, so it will go to a lease liability. So now assume that the interest rate implicit in the lease is 5%. So how will the lease liability be initially measured? How will the lease liability be initially measured? Okay, so I have done this calculation for you. I'll share this with you, but you can just put your calculators to good use. Don't write anything. It's a simple calculation that is going to flow in. The payments are made at the beginning of the year. The payments are made at the beginning of the year. You have to be very careful with the words given in the question. Okay, I have seen students go wrong here only. If the payments are made at the beginning, the time period for discount will be at a lag of 1 year, because the first payment is made right now, that is today itself. The first payment is made right now, that is today itself. Okay, so that will not be discounted. So the discounting factor for the first year remains at 1. Okay, and later on you will apply the discounting factors. Okay, so this is what is your lease liability table. You can check the lease payments this is a variable payment. This is a variable lease payment, which is linked to an index or a rate. In this case, linked to LIBOR. And on the date of commencement, the LIBOR increases at the rate of 2%. The LIBOR is at 2%. So you will increase all your lease payments at 2%. So you can check here. This is plus 2%. This is plus 2%, 2%, 2%, 2%. Just on your calculator, you can have a look at it. Okay. 2%, 2. Everywhere there is a 2% increase that is happening. Okay. That is happening. A 2% increase on the previous period. Okay. So this is what is your estimate of the lease payments. Now you will discount it using the rate implicit in the lease, which happens to be given to you, and that is 5%. So therefore, 1 divided by 1.05 raised to 0 for the first payment, because payment happens right now. So that is 1. 1 divided by 1.0 raised to 1 for payment that happens at the beginning of year 2. So on and so forth. You calculate the discounting factors and then present value and total it up. Have you understood this part? Have you understood this part? Yes. Give me a thumbs up. Is it fine? Did you understand the calculation? Did you understand the calculations? Yes. I have not done the rounding off. Okay, so your answer, if you check with the institute's answer, there is a slight difference. Okay, ICAI's answer is 8,80,887. Okay, so this is what is the answer. 100 to 100 rupees difference is on account of rounding off. Okay. Yes, it is clear. So what will be the journal entry? Assuming no IDC, no variable, no lease incentives, kuch bhi nahi hai. The journal entry that you are going to pass is, it will go to ROU asset, not the P&L. Okay, ROU asset account debit to lease liability. 8,80,751. 8,80,751. This is the entry that you are going to pass when on the commencement date. This is the entry you are going to pass on the commencement date. And then if you look at amortization of lease liability, ultimately over the 10-year period, this lease liability should come back to 0. So I have done that working also for you. How will you amortize? This is not done in your module. This is just extra for you. So the opening balance on the commencement date is 8 lakhs. You will immediately make a payment. The repayment happens at the beginning of the year. Okay, so first you make a repayment. Adjusted balance is 7,80,000. On that, interest at 5%, closing balance. Okay, so this goes for 10 years. Ultimately, you can see that at the end of the 10th year, it becomes 0. The closing balance becomes 0. Is it okay? Have you understood this part? Amortization of lease liability. Yes. Have you understood? Any doubts? Please ask. Any queries? Amortization of lease liability. All clear? Yes. So be very careful when you look at when the lease liability is going to be paid. Okay. When is the payment made? In the beginning or at the end of each year? Good to go? Yes. So that takes care of question number 27. Okay. All right. Next one. Illustration number 28. Entity Y and entity Z execute a 12-year lease of a rail car with the following terms on 1st January 20X1. The lease commencement date is 1st February 20x1. Entity Y must pay entity Z the first monthly rental payment of 10,000 upon execution of the lease. Wait here. Is execution of the lease the commencement date or is it the inception date? Execution of the lease, is it commencement date or is it? Okay, so Srinidhi is asking whether marks would be granted in exams if the answer differs due to rounding off. Definitely, you should be getting the marks. Okay, that is fine, no problem. Okay, that is fine. You can always write whenever you are taking the discounting factors or any rounding off you do, you can write down in bracket rounded off to 2 decimals, rounded off to 4 decimals, or you can say not rounded off. Okay, just mention that in your answer. So that should convince the examiner that what you have done is not an arithmetical error. Okay, so keep that in mind. That's it. Okay, so now you tell me, this payment which is made on the execution of the lease, is it the payment after commencement or is it the payment before commencement? What do you think? After commencement. Vidula is saying after commencement. Why do you think it is after commencement? We had two terms. One is inception. The other is commencement. What do you mean by commencement? Asset made available for use by the lessee. For use by the lessee. What do you mean by inception? Inception would mean agreeing the terms, execution of lease or execution of lease. So in this case, entity Y, that is the lessee, must pay entity Z the first monthly rental. That means this payment is made on the execution. That is, it is not when the rail car is made available. It is when you have executed on 1st January 20x1. So this is your inception date. This is your inception date. That means this is before commencement. This is before commencement. And because it is before commencement, I don't have a lease liability right now in my books. Okay, I don't have a lease liability. Entity Z will pay entity Y. That means this is an incentive. This is an incentive, a 50,000 cash incentive to enter into the lease payable upon lease execution. So therefore, on lease execution means this is also before commencement. This is also before the commencement. That means this also will not go in your lease liability. Any lease incentive which is after commencement goes and sits in your lease liability. We'll do a question for that. Okay. Yes, that's right, Srinidhi. Vidula, hope you understood better. Yes. So now that takes care, inception date, absolutely right. Okay, so Sheena is right, Srinidhi, good job. Entity Y incurred 1,000 initial direct cost payable on 1st February 20x1. IDC, initial direct cost, do not look at inception date or commencement date. Why? Because initial direct costs are payments made between the lessee and a third party. For example, IDC means what? You have to pay some brokerage, you have to pay some stamp duty, you have to register it. So therefore, these are costs made for getting into the lease arrangement, which is not paid to the lessor, but which is paid to a third party altogether. And therefore, these initial direct cost के लिए whether you pay it on inception or commencement कोई फर्क नहीं पड़ता, because this is not at all going to go in your lease liability calculation. This will never go in your lease liability calculation. It will go only in your ROU asset. Okay. Entity Y calculated the initial lease liability as the present value of lease payments discounted using the incremental borrowing rate because the rate implicit in the lease could not be readily determined. Okay. So the initial lease liability is 8,50,000. How would the lessee company measure and record this lease? So therefore, initial measurement, they have already measured the lease liability at 8,50,000. So corresponding debit should go to the ROU asset. So therefore, ROU asset also will be 8,50,000 plus there will be some additions. Plus there is a payment made of 10,000 prior to the commencement date. That's right, Vidula. Okay, that's right. Okay. So therefore, lease payments on inception, not commencement, which is 10,000, and then you will have lease incentives on inception. This is a receipt, so therefore it will be deducted. If it were to be received after commencement, it will go and sit in my lease liability calculation. We have a problem on that as well. Okay. Plus IDC of 1,000. Initial direct cost of 1,000. So this is going to give you your lease ROU asset, which appears at 8,11,000. Okay, so fairly simple question. Kuch tha nahi isme. Okay, nothing great in this. Okay, so now the next one, illustration number 29. That was illustration number 28 for you. Illustration 29. Company H leases an aircraft for a period of 5 years. The aircraft must undergo a planned check after every 1 lakh flight hours. At the end of the lease, Company H must have a check performed or refund the cost to lessor irrespective of the actual number of flight hours. What are the lease payments for the purpose of calculating ROU asset? Now just look at the question. What do you think are the obligations of the lessee? Who is the lessee? Lessee is Company H. What do you believe are the obligations? What do you believe are the obligations that are there on Company H? What do you believe are the obligations? What do you believe are the obligations? Obligations kya hai? In this lease, on the date when you have taken the aircraft on lease, what are your obligations? Yes, what are your obligations? Respond. Any answers? Achha. Okay. To have a planned check after every 1 lakh flight hours. Okay, that's it. To perform a check after every 1 lakh hours, and here Priya is answering to perform a check of the aircraft at the end of the lease irrespective of the flight hours. Okay, so now see, whenever we talk about a provision whenever we talk about an obligation, okay, जब हम ऑब्लिगेशन के बारे में बात करते हैं तो ऑब्लिगेशन क्या होता है? व्हाट इज द मीनिंग ऑफ एन ऑब्लिगेशन? ऑब्लिगेशन का मतलब होता है देयर इज नो पॉइंट ऑफ रिटर्न. मतलब क्या है? आई हैव टू सेटल द लायबिलिटी, आई डू नॉट हैव द ऑप्शन ऑफ नॉट सेटलिंग इट. So that is how Ind AS 37 defines provision. Okay, provision is a liability of a amount that can only be estimated. I do not know the final amount right now, but it is an obligation. It is an obligation. And obligation means what? Obligation means today when I'm evaluating my position, I know that I have to settle a particular liability or I have to settle a particular provision. There is no realistic alternative for me apart from settling. Now look at this case. Planned check every 1 lakh hours. Is this an obligation? अगर आप पढ़ोगे, if you read it just like that, it appears yes, it is an obligation. But now look at it carefully. If you do not complete 1 lakh hours, do you have to undergo a planned check? If you do not complete 1 lakh hours, do you have to carry out the planned check? Answer is no. That means this obligation is dependent on you flying the aircraft for 1 lakh hours. So therefore, this obligation is dependent on future events. This obligation is dependent on future events, and therefore I cannot call it as an obligation right now. At the most, what I can do is I can say that it is a contingent obligation. It is contingent upon me flying the aircraft for 1 lakh hours. So therefore, though it appears to be an obligation, it is not an obligation. I will not make a provision for this in my books. You will not say, I estimate 1 lakh hours will be completed. See, Ind AS talks about being realistic. Okay. Ind AS talks about being realistic. Conservatism is a thing of the past. पहले हम लोग क्या करते थे? We used to make a provision and keep it. अरे, who knows what is going to happen in future? Make a provision and keep it. And then what people used to do, they would use this provision for a window dressing. Suppose आज मेरा profit ज़्यादा है, then they would make a provision, reduce those profits to manageable levels for the stakeholders. In the next year, the profit कम होता था, they would reverse the provision and increase the profit. So they were using these provisions as a window dressing element. So therefore, now Ind AS 37 said nothing doing. Obligation or a provision will be made for an obligation only if the obligation exists without any dependency on future events. So therefore, in this case, completing 1 lakh hours is a future event, which I do not know right now. And therefore, this is an obligation which is dependent on future events, and therefore you will not make a provision for it. However, there is one more obligation, which is a check at the time of return of the aircraft. Return of the aircraft. मतलब at the end of 5 years, जब मेरा lease tenure खत्म होता है, at the end of 5 years when my lease term is over, that point of time I will have to do a check, and that is a point of no return. No return means what? I have the obligation on my head, I cannot escape that obligation. So first one is either I do it myself, so perform the check, or second one is pay to the lessor so that the lessor will perform the check. Pay to lessor for the check, regardless of what are the number of hours that you have completed. Regardless of number of hours flown. Now look at this. Look at this. Check at the time of return. Now look at this. The aircraft will go at the end of 5 years to the lessor. Yes. So no doubt about that. You have to perform the check Yes. नहीं sir, but option है. I can also reimburse the lessor. हाँ, तो either you perform or reimburse. मतलब there is a liability on your head. Yes. Is it dependent on number of hours flown? No, it's not. Whatever be the position, हो सकता है at the end of the 4th year and 364th day, you had done a check. Again, at the 4th year and the 365th day, before returning, you have to perform the check. So therefore, regardless of number of hours flown, you will perform the check. And therefore, this is a liability which is not dependent on any future event. It has already crystallized the moment you entered into the arrangement. And therefore, this is an obligation. This is an obligation. This 1 lakh every future hours, every future 1 lakh hours is dependent on a future event. So therefore, we cannot take that as an obligation. So this obligation is to be incurred after 5 years. So it is a liability. So what do I do? You guys remember something known as site restoration cost or decommissioning obligation? This is somewhat similar to that. Okay, somewhat similar to that. Though in this case, it is an obligation for what you can say, inspection of the aircraft. Obligation for inspection of the aircraft. Okay, so this obligation is already there. So discount it to the present value and add it to your ROU asset. Add it to your ROU asset. Ind AS 37 is very beautiful in describing what is a provision when an obligation arises. Okay. So this obligation, what you will do, discount to present value and add to ROU asset. So if you look at this, what are the lease payments for the purpose of calculating the ROU asset? It is only the present value of the obligation that you will have at the end of the 5th year. At the end of the 5th year. So Sheena, I hope you understood. Srinidhi has confirmed. Priya was right. Vidula, hope you understood. Mahinder, pata nahi kahan chale gaye. Today Ayush is not there. Okay, so I hope you guys understood the question. Okay, all right. So dismantling costs will be included. Okay. Done. Anybody has any doubt so far? It will go in your ROU asset. Okay. All right. I'm leaving illustration 30 for homework because we are doing fairly complicated illustrations now. ये बहुत simple है. So I do not want us to waste time understanding this because whatever concepts are there here, I will discuss even when I'm doing the subsequent illustrations. Okay. So I'm leaving this for homework. Kuch nahi, you need to calculate lease liability, discount it to present value, and then you do the lease liability accounting. Okay, so just do it. I'm leaving it for homework. Okay, illustration 31 is important. Illustration 31 is important. It is also right of use asset and lease liability. Okay, so company EFG enters into a property lease with entity H. The initial term of the lease is 10 years with a 5-year renewal option. Okay. The economic life of the property is 40 years. The fair value of the leased property is 50 lakhs. Company EFG has an option to purchase the property at the end of the lease term for 30 lakhs. The first advance annual payment is 5 lakhs with an increase of 3% every year thereafter. The implicit rate of interest is 9.04%. Entity H gives company EFG an incentive of rupees 2 lakhs payable at the beginning of year 2, which is to be used for normal tenant improvement. Who is paying whom? Entity H is paying to EFG. So entity H is the lessor, EFG is the lessee. And when is the payment being made? This payment is being made after at the beginning of year 2. That means year 1 is done. So therefore, this payment is made after commencement. After commencement. So will it form a part of lease payments for the purpose of ROU asset? Answer is no. Will it form a part of lease payments for the purpose of lease liability? Answer is yes. Sir, ultimately lease liability goes into ROU asset. That is fine. But you cannot increase the ROU asset without increasing the lease liability in this case. पहले वाले केस में क्या हुआ था? When the lease incentive of 50,000 was paid before commencement, lease liability was not there at all. So that is why it went into the ROU asset. In this case, there is a lease liability. So lease liability will go down with a corresponding impact, obviously, in the ROU asset. Okay. So now, company EFG is reasonably certain to exercise the purchase option. How would EFG measure the right of use asset and lease liability over the lease term? Okay, so this is the question. We immediately go to the answer. Okay, again, it's a fairly long calculation, but that is not important right now. It's more about understanding how the concepts are going to flow. Okay, so when are the payments going to be made? The first, you have to read the question very, very carefully. Okay. See, check here. First, advance annual payment is 5 lakhs. That means payment is made at the beginning. And the 30 lakh payment at the end of the lease term. At the end of the lease term. So read the question with microscopic precision. Okay. Because you make a mistake here, you will apply wrong discount rates, you will do wrong calculations, and you will end up losing marks. The sad part is you will not even know you have lost marks, because out of the exam hall when you come, you will say that lease ka question to kitna aasan tha yaar, it was so simple. I never believed institute could ask such a simple question. And then when the marks are allotted to you, you will find yourself regretting the fact that you had not read the question properly. Okay, so read the question. These small things which are there, no, institute takes great pleasure in troubling your lives. Okay, so anyways, the first payment is made at the beginning of the year of 5 lakhs. Okay, how this has happened, sir? 3 lakh 15. Well, every year there is an increment of 3%. Is it a fixed payment or variable payment? Sir, it is a fixed payment. Sir, why fixed? Determinable amounts. I know the amounts today, right on the date of commencement, how much I have to pay. And that is not going to change. Every year amounts change, doesn't matter. It is determinable today. And therefore, it is a fixed lease payment. So therefore, how did I get this 5 lakhs? Well, each year it increases by 3%. So 5 lakhs plus 3%, that gives you 5 lakh 15,000 minus a lease incentive of 2 lakhs. So this comes to 3 lakh 15,000. This comes to 3 lakh 15,000. And then how did I get this 5 lakh 30,000? 450, 5 lakh 15,000 plus 3%. So that is equal to 5 lakh 30,000 450. This is how you are going to get. And after this, every increase is of 3%. Every increase is of 3%. 3%, 3%, 3%, 3%, 3%, 3%, 3%. At the end of year 10, that means after the lease term is concluded. So at the end of the lease term, okay, they have said to purchase at the end of the lease term for 30 lakhs. So therefore, end of year 10, you are going to acquire it for 30 lakh rupees. You are going to acquire it for 30 lakh. So now, how will I do the accounting? Is it a purchase option that is there? Yes. Is it reasonably certain to be exercised? Yes. And therefore, what are you going to do? You will take it to your lease liability calculations. Now, they have given 9.04%. If you take it as 9.04%, this answer comes to 49,99,000 something. Okay, so it comes to 49,99,764 ऐसा कुछ आता है. Okay, so what I have done was I have actually calculated the IRR and I have taken the actual IRR just to show that IRR ultimately flows and makes your value of present value of payments equal to the fair value which is given to you as 50 lakh rupees. Okay, so this is your actual IRR. When you see my Excel sheet, it is 9.040205 something like that. Okay, so it doesn't matter. In your exam, if it comes to 49,99,000 something, you can either take this figure and give the answer, no marks will be deducted. You can round it off to 50 lakhs and give the answer, no marks will be deducted. Okay, so this is 5 lakhs and then it's just a discounting. So once you discount it, your total comes to 50 lakh rupees. Your total comes to 50 lakh rupees. And then when you do the amortization of lease liability, ultimately your opening lease liability is 50 lakhs. The repayments are happening first, 5 lakhs. So adjusted opening balance, this is the IRR. I have kept it here, 9.04087927%. Okay, so 4 lakh 6 closing balance. Opening repayment is flowing exactly from here. Okay, whatever is the lease payment here, that is the repayment. Okay, so 3 lakh 15, 5 lakh 30, all these things are exactly going to be the same. All these things are exactly going to be the same. Is it okay? Have you understood this part? Yes. Have you understood this? Acha, how is 5 lakh 15 calculated? You can check here. See what they have told. With an increase of 3% every year. With an increase of 3% every year. So my first payment was 5 lakhs. I increase it by 3%. So 5 lakh plus 3% gives you 5 lakh 15,000 minus this is the incentive. This is the incentive. You can see the incentive is flowing in the lease liability calculations. It is flowing in the lease liability. That is why it will not come separately as an ROU asset item. Okay. So this is 3 lakh 15. Okay. So Srinidhi, hope you understood. Others, hope you understood the computation now. Did you understand the calculations? Have you guys understood? Srinidhi, did you follow 5 lakh 15? Others, any doubt so far? You can just do 2 to 3 computations on your calculator and then that should kind of take care. That should take care of your workings. Yes. What would be the change if the lease incentive is received before commencement. So Sheena, if this 2 lakh is received before commencement, it would directly go to ROU asset calculation. It would directly go to ROU asset. You would get it. So the entry would be bank account debit to ROU asset straight away. This is in fact what we did in the previous question. This is in fact what we did in this question. Okay. Less lease incentive on inception. 50,000 prior to commencement. So that goes into the working. Okay. All right. So Srinidhi understood. Priya understood. Sheena Jain, hope you understood lease incentive prior to commencement. Prior to commencement. Yes. Who is this? Vidula, right? So it is this rate only. This is the same rate. Okay. No change. This is given to you in the question. Here I did not. I took the full figures for you. It is in fact the same rate here. Okay. So the rate is exactly the same. No change. Okay. It is the IRR. So you will discount using the IRR and then you will record the interest also using the IRR. What we commonly say as unwinding the discount. Okay. So Vidula, hope you understood that. Sheena, hope your query got sorted out. Yes. Any other doubts you guys are having? So what are you going to do? You will record the ROU asset account debit to lease liability 50 lakhs. You will depreciate the ROU asset 50 lakhs over the time, over the lifespan of the asset now, because you are going to acquire the asset. Okay, so that is 40 years, I think. You will also record the lease liability as if it is a financial liability. So every year you will have a finance cost. Every year you will show the repayment and you will get the closing balance. Okay. So both of you, did you understand? Sheena Jain got it. Lease incentive prior to commencement will be a reduction from ROU asset. It won't be a part of lease liability because liability does not exist in the first place. Okay. Yes. Both of you, did you understand? Bolo, tell me, I'm waiting for your answers. Yes, sir. Vidula, that 9.04 is this rate only, same rate it is. Okay. When you get the Excel sheet, you will come to know. Okay. It's the same rate, nothing else. Okay. All right. So that takes care of this part. 1 second. Just a minute. 25. Okay. I just have one small concept to explain to you for the purposes of the previous problem. Okay. What I will do is, I had told you to do this for homework, but I will explain one concept regarding this from the institute study material. Okay. This is illustration 26. 30. Something that I think will help you out. This is done. Yeah. So this is the one. Okay. See, the facts of the case. Enters into a 3-year lease of equipment, payments made at the end of each year. So 20,000, 30,000 in year 2, 50,000 in year 3. So you are making cash flows of 20, 30, 50. Total is 1 lakh. Okay. The discounting factor assumed to be 12%. So when you take the discounting, this is at the end. Okay, this is at the end. So 0.89297972. So your lease liability comes at 77,364. Okay. Now you will prepare the lease liability amortization table. So opening balance 77 plus interest minus payment closing. Okay, plus interest minus payment closing. So now what is your total interest expense? Your total interest expense that you would be incurring is 9284 plus 7998 plus 5354. Your total interest expense over the 3-year period comes to 26,636. The ROU asset is 77,364. So when you depreciate it over the 3-year period, your ultimately depreciation will be 25,788 into 3, which is 77,364. Okay. This is your depreciation. This is your interest over the 3-year period. Now this is your interest. This is your depreciation. Total both of them, add both of them, it comes to exactly rupees 1 lakh. And what is this 1 lakh? This 1 lakh is the lease rent which you are going to be paying over the 3-year period. Okay. So therefore, what I'm trying to stress is you are not making any notional incomes or notional expenses. The interest in this case is not notional. Depreciation is not notional. The total expenses that you will be charging to the P&L is 1 lakh rupees, shown as 22,636 interest and depreciation of 77,364. Only thing is, I will not show these expenses in the manner I'm paying the cash. I will be showing it in a different manner. But what is important is whatever outflow is there, that exactly is going to be my expense that will be recorded in the P&L. So the highlight is it is not a notional expense that we are recording. It is a genuine expense that we are doing the accounting of. Okay, so is this part clear, everyone? It was a small concept, not very important, but I thought that you will have to understand it. It's better for us. Okay, it's better. Okay, so have you understood this? Have you understood this particular concept? Yes. Vidula, that interest rate, I hope you understood. Guys, respond. Okay, respond. The faster answers you give, the more we can. We have special cases, lots to be done there. At the same time, we are also having a small amendment that is already there in this Ind AS. Okay, so you respond and we can proceed further. Sheena Jain was the earlier katha. Okay, महेंद्र को समझ में आ गया. Yes, बाकी के लोग, शीना, विदुला, श्रीनिधि. Did you guys understand? Please respond. If you've not understood, tell me. I will be more than happy to address you. Yes. This particular concept, did you understand? Got it. Depreciation plus interest is equal to total lease payment. Absolutely. That's a beautiful summary. So now we proceed to this question was done. This is done. Okay. This is a small concept that is there. Leases denominated in the foreign currency. So now what you are having is, when you pass the asset ROU asset account debit to sorry, to lease liability. How many of you have studied Ind AS 21? You would have studied Ind AS 21, or if not, you would surely have studied AS 11. So in AS 11 or Ind AS 21, there is something known as a monetary item, non-monetary item. So monetary item, you will have to restate it at the closing rate at the end of each balance sheet. And the non-monetary item, you can continue to carry it at the historical cost. So whenever you restate a monetary item, the difference goes to your profit and loss as exchange difference. Okay, so that is the concept that is there. Now ROU asset is a non-monetary item. Non-monetary item means I cannot convert it into determinable sums of money. I cannot monetize it. Okay, suppose in the earlier question my ROU asset was appearing at 77,364. Does it mean when I try to sell that asset, can I get 77,364? No. In fact, most of your forget ROU assets, most of your normal assets are also non-monetary. Take any item of property, plant and equipment, take any investment property, take all these items where you are having inventories, for example. Okay, so all these are non-monetary items because they are not convertible into determinable amounts of money, whereas your lease liability is a monetary item. I know for sure precisely how much I have to pay towards the lease liability. I know that for sure. Okay, there is no doubt in that. And therefore, if you have a lease which is in a foreign currency, the ROU asset would appear at the historical rate. ROU asset would appear at the historical rate, but the lease liability would appear at the closing rate. And on account of restatement, the gain or loss would be taken to the P&L. Okay, so you will take the thing to the profit and loss account. Any difference arising on account of foreign exchange fluctuations. Baki, the principle remains the same. The principle remains exactly the same. So initially when you do the measurement, you will do the measurement applying Ind AS 116 principles. At the end of each year, you will restate the lease liability. Okay. So this is one RTP question that is there. Okay. So entity X is an Indian entity whose functional currency is the Indian rupee. It has taken a plant on lease from entity Y for 5 years to use in its manufacturing process, for which it has to pay annual rentals in arrears. What do you mean in arrears? It means that at the end of each year, of US dollars 10,000. So now on the commencement date, the exchange rate was rupees 68. Average rate for year 1 was 69, and at the end of year 1, the exchange rate was rupees 70. Okay. The incremental borrowing rate on commencement of the lease for a USD borrowing was 5% per annum. So how are you going to recognize the ROU asset and lease liability at the end of year 1 is the question. Okay. So how are we going to calculate this? Okay. So first things first, I have not solved it in the Excel. We'll do it quickly right now. Okay. So initial measurement. initial measurement. The lease liability is the present value of all future lease payments discounted using the discount rate which is given. In this case, the leases are denominated in US dollars. So first you calculate it in US dollars and then you convert it to INR, because using which rate? Using the date of the transaction, which is the date that is the initial measurement date. Okay, so in this case, it is year 1, 2, 3, 4, 5-year lease period. The rentals are lease payments. This is in USD. 10,000, 10,000, 10,000, 10,000, 10,000. Okay. Next, what is your discount rate? 5%. So discount factor at the rate of 5%. So that gives you 1 divided by 1.05, 0.952 divided by 1.05, 0.907 divided by 1.05, 0.864 divided by 1.05, 0.823 divided by 1.05, 0.784. So present value of lease payments. So 10,000 into 0.952, 9520, 9070, 8640, 8230, 7840. So this is 9520, 9070, 8640, 8230 and 7840. 43,300 US dollars. Now this is the present value when you have entered into the lease arrangement. But can I keep 43,300? No, I am an Indian entity. I have to report it in the functional currency, that is INR. So multiplied by spot rate. That is the rate when you have entered into the transaction. On commencement date, the exchange rate was USD 68. Spot rate on the date of commencement, which is rupees 68 per dollar. So 43,300 into 68, that gives you INR 29 lakhs 44,400. 29 lakhs 44,400. So on the initial date, what is the journal entry that you are going to pass? You will pass initially ROU asset account debit to lease liability. That is 29 lakhs 44,400. 29 lakhs 44,400. Have you understood this part, everyone? Yes. Therefore, ROU asset depreciation per annum 29 lakh 44,400 divided by 5 years. Divided by 5. So that gives you 5 lakhs 88,880 rupees. Okay, so 5 lakh 88,880. Okay, so this takes care of the ROU asset. So end of year 1 ROU asset is equal to $29. 23. So 29, 44, 400 minus 5,88,880. So that is equal to rupees 2355 520. This is my ROU asset. This is my ROU asset. Okay. I'm also calculating side by side. Okay. Now we move on to lease liability. Acha. Can I do the lease liability workings using 29,44,400? Answer is no. It is a lease which is denominated in US dollars. So you will have to do the workings in US dollars and then you will convert it. And then you will convert it into INR. Okay. So lease liability, initial value. This is on the date of commencement. Okay, it was 43,300 USD plus interest at the rate of 5%. So 43,300 into 0.05. So that is USD 2,165 minus, you will pay the liability, minus payment USD 10,000. So that gives you 35,000 closing balance. USD 35,465. Okay, so this is what happens in dollar terms. Now I will have to convert this into INR. This is an expense. So I will convert interest using the closing rate. I will convert interest using the closing rate. Interest expense account debit to lease liability. USD 2165 into what rate am I going to use? Interest accrues throughout the year. So you will be using an average rate. So the average rate is going to be 69. Average rate for year 1 is 69 into rupees 69 per dollar. Okay, so 2165 into 69. So 1,49,385. 1,49,385. So far, is it clear, everyone? So far, is it clear? Yes. Till now, is it clear? Any doubts? No doubts. Yes. So far, clear. Priya Garg has confirmed. Interest will obviously be on an average rate, okay, because it is accruing throughout the year, right? So this is Ind AS 21 principles or AS 11 principles or whatever you have studied. Okay, so Priya Garg has confirmed, Vidula has confirmed, and Suraj, hope your query is addressed. So now look at the story. Okay, now look at the story. US dollar INR. Initial liability was 43,300. Equivalent was 29,44,400. Add interest 2,165. This is 1,49,385. Less payment was 10,000. And here you are paying it on the last day, right? So at the end of year one, exchange rate was 70. So the equivalent amount of this is going to be 7 lakhs. 7 lakhs. Okay. So the closing balance should be 43,300, 2,165, 10,000, 35,465. Now, this balance comes to 29,44,400, 149,385 minus 7 lakhs. 23,93,785. But I cannot stop here. Because 35,465 is a monetary liability. And therefore, ideally, I should convert and restate the monetary lease liability at the closing rate, which is rupees 70. So when I convert this at rupees 70, the closing rate per dollar, 35,465 into 70, this comes to 24,82,550. Okay. So a liability which by your working was 23,93,785, monetarily by converting at the closing rate is actually worth 24,82,550. The movement between these two is only and only on account of exchange rate fluctuations. So therefore, the difference of 88,765 is exchange loss, which goes to the P&L. This difference is exchange loss, which goes to your P&L. Suraj, it won't go to FCTR. FCTR ke case mein, it is only specified items which go to your foreign currency translation reserve. Okay. Items like when you are when you are converting the financial statements of a foreign subsidiary into your Indian parents for the purpose of consolidation, that time it goes into your FCTR. Or when you are converting an what you can say an advance which is in the nature of capital, then you will take it to FCTR. This you will not take it to FCTR. It is a liability. It will go to your profit and loss account. It's a liability. It's not an item of equity. Okay. So that will go to your P&L. Okay. Okay. P&L. All right, great. So Srinidhi confirmed, Suraj has confirmed, others have all confirmed. So that takes care of accounting in the books of lessee. Okay. Okay. All right. In 5 to 10 minutes, we will quickly complete accounting in the books of lessor. It is something which you already know. Okay, so I do not have to go into great detail. The accounting of lessor is same like what we used to do in Ind AS 17 or Ind AS 19. Okay, accounting is largely on the lines of Ind AS 17/AS 19. Means what? The classification of finance lease and operating lease, what we used to do earlier for a lessee, that got eliminated. उसके जगह में क्या आ गया? ROU asset, lease liability, along with some optional exemptions for short value leases as well as short term leases. Okay, so that is lessee story. Lessor के case में there is no change. So lessor will do the accounting by first identifying whether he believes the lease to be a finance lease or an operating lease. If it is a finance lease, what is a finance lease? The risks and rewards incidental to ownership are transferred to the lessee. So the standard has given 5 indicators, which is exactly the indicators which you have already studied in your AS 19/Ind AS 17. Normally it is AS 19 which you would have studied. So the ownership transfers at the end of lease term. This is the first indicator. Or purchase option available at a price substantially lower than the market price, and it is highly likely that lessee will exercise the option. Second case. Or major part of economic life is given out for lease that is more than 75% normally. Or fourth, present value of minimum lease payments substantially cover the fair value of the asset, usually more than 90%. Okay. Or specialized nature of asset, cannot be used by others without a major modification. If any of these 5 conditions are fulfilled, it is a finance lease. Okay, any one condition. If all the 5 conditions are not fulfilled, then it becomes an operating lease. This classification has to be done by the lessor. And if you look at the accounting, it is again same accounting that we used to do. Okay. First we look at operating lease, that is the simple one. Operating lease में what the lessor believes is asset मेरा ही है. I have just given it for a temporary use to earn rental incomes. So the entry will be bank account debit to rent income. I will explain what is deferred rent in a short while. Okay, abhi ke liye just park it. Okay, right now it is just for getting rental income. So bank account debit to rent. If it is an operating lease, the asset remains in the books of the lessor. So the lessor will also charge the depreciation. So depreciation account debit to the P&L. So this goes in your P&L, and that's about it. Operating lease, only so much. If it is a finance lease, you are transferring the asset. So the asset will be credited at the WDV because asset is going out. Okay, so asset will be credited at WDV. Okay. In its place, what are you going to get? You are giving it on lease, means you are in effect collecting amounts over a period of time. So lease receivable account debit. And this difference between these two could either give a loss, or a gain. So P&L debit bhi nahi hoga, credit bhi nahi hoga. It is either of the two. Okay. So this is what happens in a finance lease. Asset goes away from my books. So therefore there will not be any depreciation. And in the case of receipt of the lease payments, the entry will be bank account debit. I will apportion it to finance income and lease receivable based on the lease amortization tables that we just now have done. Okay. So like we used to do lease amortization table there, we will do a lease receivable amortization table in the case of lessor and apportion the lease payment received between finance income and lease receivable. Now the question is, what do you mean by lease receivable? How will you record it? Lease receivable should be recorded at net investment in the lease. What do you mean? See, today, year 1, I will give the asset on lease. Lease given. End of year 5, end of lease term. So what happens is when lease is given, suppose you are transferring the asset also. So the sale of asset happens immediately, but you are collecting the amounts over a period of time. That means from year 1 to year 5, you will have to recognize the finance income. You will have to recognize the finance income. And that is why when I talk about net investment in the lease, I will have to discount the total lease payments and bring it to the present value. I will have to discount the total lease payments and bring it to the present value. So what is the total lease payment from lessor's perspective? Now look at the lessor. Lessor has the asset. So what all lessor will get? Lessor will get the lease payments. Lessor will get any guaranteed residual value from the lessor, which is already included in the lease payments. And the lessor will also get unguaranteed residual value, which is over and above the guaranteed residual value that is given to him. Okay, that means lessor is going to get in all three streams of cash flows. Pehla stream, annual or monthly, whatever the lease rentals. That is the first stream. Second stream is if there is a residual value guarantee with the lessor, with the lessee, he will get that. But where is residual value guarantee of lessee included? It is included in the lease payments. Look at the lease payments chart, the last item, payments made under a residual value guarantee. That is included. Okay, so you will take that into consideration. All right. And finally, there is something that I may realize which is not guaranteed by the lessee. So that is known as unguaranteed residual value. So these three cash flows, essentially two, will be discounted to the present value. So net investment in the lease is nothing but present value of lease payments plus present value of unguaranteed residual value. Sir, GRV, where is guaranteed residual value? That is included in the lease payments. Okay, so including guaranteed residual value, including guaranteed residual value. Okay, so that takes care of net investment. Gross investment means what? Forget the discounting. Straight away, these payments at whatever amounts you are taking, you will recognize it at that amount. Okay, so that is the gross investment. So difference between the gross investment and net investment is the discounting amount, which is basically your unearned finance income. Why do I call it as unearned? Initially, it is unearned. At the end of each year, you start to earn or accrue that finance income. Okay. And what is UGRV? Expected residual value. What you expect your asset will fetch at the end of the lease term minus what is guaranteed. If it is positive, it is unguaranteed residual value. Okay. So that takes care of the first part, most important part. Okay. Now, what do you mean by this deferred rent? What do you mean by this deferred rent which we had recorded? Okay. So far, is it clear, everyone? So far, is it clear? Accounting in the books of lessor. So far, is it clear? Suraj, not sure. I think you typed something by mistake. GIL. Gross investment in lease is nil. I'm not able to make out what you have written. Others, are you kind of able to recollect what is written? Yes. Are we able to recollect something? Bolo. Yes. Little bit familiar. Yes, Mahinder ne bata diya. Now we proceed to what is this deferred rent? What is this deferred rent? Suppose we have a case where Okay. Now see, pay attention. We have given a space on rent. The same space. There is no change in space. I am the lessor. I conclude it is an operating lease. Okay. Same space is given, but year one, I will collect rent of 100. Year two, I will collect 200. Year three, 300. Year four, 400. Now, the total lease rent that I am collecting is 43729,000. Total lease rent that I am collecting is 1,000. Now, the thing is, I have not increased the property given. I have not given any other benefit. Then why should the rentals increase over a period of time? So what the standard tells is, if there is no other benefit, if you have given the same area, the same space, you can go for a straight lining option. Ideally, rental should increase if, for example, your area given on rent increases. Suppose you gave here 20 square meters. Okay. Or here in this case, you gave suppose 10 square meters on rent. I know it's a very small number. Then you gave 20 square meters, 30 square meters, 40 square meters. If this is what you are giving on rent, fine. Your lease rental income in the books of lessor will be 100 for first year, 200, 300, 400. But suppose this is not the case. You have given the same amount. You have given the same amount on the same area on lease. So what the standard tells, there is no basis for you to recognize increased income in the future. So therefore, your lease rental income is equal to 1000 by 4 is equal to 250. So what are the journal entries that you will pass? Year 1, bank account debit 100 to rental income. To rental income, it will be 250. And this 150 difference is what you will be parking in your deferred rent account. This is what you will be parking in your deferred rent account. Year 2, bank account debit 200 to rental income 250, debit another 50, deferred rent account. Year 3, bank account debit 300 to rental income 250 to deferred rent 50. And year 4, bank account debit 400 to rental income. You are straight lining the income, and whatever is the deferred rent that you had recognized is now entirely reversed. It was 150 debit, 50 debit 200, 50 credit, 150 credit, 200 is credited. So over the 4-year period, you are essentially straight lining the income because you have not given anything extra. So when you have not given anything extra, you cannot book the income on a straight line base. You cannot book the income in the manner in which you are receiving. You have to do a straight lining. So that is what the standard tells when it tells lease rent income should be recognized on a straight line basis unless another systematic basis is more representative. So for example, that area I told 10, 20, 30, 40, if you give that area on lease in that manner, then you record the income in that manner. Otherwise, you follow the straight line basis and park the difference in deferred rent. Ultimately, over the tenure, the deferred rent will be reversed entirely. So this is also explained now. Okay, this I have explained. Okay, so fairly simple. All right. Fine. So we take a break now. We take a 5-minute break. We are hard pressed for time. I still am yet to start with special cases. We take a 5-minute break and we shall resume. If you have any doubts, please feel free to ask. If you have understood, please let me know that you have understood. Okay. We take a 5-minute break. We shall resume at 9:35. Okay. We shall resume. Okay. All right, guys. So welcome back. It will extend, Sheena. The class will extend for some time. Okay. There are lots that I have to cover. Okay. They say, no, I have miles to go before I sleep. And miles to go before I sleep. Okay. It's coming to that stage. We have to extend quite a lot. Okay. All right. Now, if you compare with the lessee's books, okay, lessee's books, the lease liability is recorded as present value of lease payments. Present value of lease payments, which is nothing but lease rentals plus guaranteed residual value. Okay, this is, I'm just keeping it very simple. Just forget for the time being variable lease, or what you say, uh, lease incentives, all those things, IDC, just for the time being, just park it separately. Whereas in the case of lessor's books, the lease receivable is going to be present value of lease receipts, which is again nothing but lease rentals plus GRV plus UGRV. Okay, so he will also recognize the UGRV. So the important point is this UGRV is not recorded by the lessee. This UGRV is not recognized by the lessee. Why? What will he know how much will be the UGRV of the lessor? He cannot be expected to know the UGRV of the lessor, and therefore the lease receivable in the lessor's books and the lease liability in the lessee's books, rarely it matches. Okay, it never matches. So your understanding of accounting, where an asset in one book is a liability in the other books, is fairly going to be tested in today's session, when first thing is the liability in the lessee's books and the receivable in the lessor's books are not going to be the same. That is the first takeaway. Second takeaway, suppose this is an operating lease in the books of the lessor. So lessor will recognize the asset in his books. So that is the first point. But the ROU asset can be correspondingly recognized by the lessee in his books. So therefore, another what you can say anomaly or another mismatch in Ind AS 116 is I can have assets in both the books. Matlab lessor also will have the asset, lessee also will have the asset. That is one thing which is where there is a mismatch here. Okay, so Ind AS 116 still has some issues that need to be ironed out. Okay, it's not yet a completely perfect standard. Nothing is. There are some lacunae, some loopholes, some mismatches here and there, but these are the mismatches which is quite visible. Okay. Now we come to the accounting in the books of the lessor we have seen already. Now let us take a very specific case of a manufacturer lessor. Okay, let us take a very specific case of a manufacturer lessor. Who is a manufacturer lessor? Well, a manufacturer lessor is one who manufactures the goods as well as gives them on lease. So for a manufacturer lessor, there are two streams of income. First is sale of goods. First is sale of goods plus finance income. Finance income from leasing. Finance income from leasing. Now the question arises, how will the accounting happen for a manufacturer lessor? So far, whatever accounting I gave you was for a pure lessor. If I apply the same concept to a manufacturer lessor, just try to understand with the help of this case. Okay. Suppose a manufacturer lessor gives an asset on lease for 5 years. asset reverts back to the lessor after 5 years. Okay. Useful life is 8 years. Useful life is 8 years. Now the question arises, how will this particular transaction be recorded? Let us assume that this transaction involves transfer of risk and rewards incidental to ownership. Transfer of risks and rewards incidental to ownership. That means it is a finance lease. Basically, all risk, rewards, everything are transferred. So accounting will be as if it is a finance lease. Now the question arises, how do I do this accounting? Sir, उसमें कौन सी बड़ी बात है? We'll do a simple, we'll recognize a lease receivable. Acha. How are you going to recognize a lease receivable, sir? What is the big deal in that? Present value of lease rentals plus unguaranteed residual value. Present value of lease rentals plus unguaranteed residual value. Sir, why will I have this unguaranteed residual value? Arey sir, what are you talking? I am going to get back this asset after 5 years, correct? So I will use this asset for 3 years, correct? So that 3 years becomes my unguaranteed. Oh, Vijay Rajeshri, good to see you. Today is the last class on Ind AS 116. Okay. Today is the last class. All right. Okay. So this unguaranteed residual value is going to be there for the 3 years when the asset reverts back to the lessee. Now understand the problem. This fellow is a manufacturer lessor. He will treat this as a sale of goods. So for him, this lease receivable is basically sales. And for him, there will also be a cost of goods sold. Now, when I talk about sales, what do you mean by sale? When there is a transfer of risk and rewards incidental to ownership, for which the lessee pays a consideration. So therefore, if I have to talk purely about a sale transaction, I have to take into account in the sale consideration only the present value of lease rentals. I cannot take this UGRV because UGRV is not guaranteed sale value right now. It is an estimate of the unguaranteed residual value that I am going to get in the future, which I am recording right now because that is what is the worth of my asset, is what I believe. So there will be a lease rental, there will be a present value of these lease rentals plus the present value of UGRV if I had to follow Ind AS 116. But now I am a manufacturer lessor, and manufacturer lessor means I can take into my sales value only those amounts which reflect the guaranteed flows that come from my lessor. I cannot take any XYZ value that I expect to be realizing after 3 or 5 years. I cannot do that. Ind AS 115 does not allow that because that would amount to a recognition of revenue before it is actually materializing. You are saying I am recognizing income in year 6 to 8 today itself. How can that happen? That cannot happen, right? So therefore, when we are talking about a manufacturer lessor, look at the cases now. Okay. For a pure lessor, the finance lease or the lease where the sale was there, the entry looked something like this. Okay. Lease receivable debit to asset to P&L, to gain which went to the P&L. This was how you used to do the accounting for a pure lessor, because he was selling an asset. But now if you talk about a dealer or a manufacturer lessor, it's not a pure P&L transaction. It is an actual sale. It is an actual cost that you are going to incur. So now the entry goes something like this. Lease receivable account debit. You will follow the Ind AS 116 recognition here. To sales. You are actually selling something, so you will record the sales. For what you are selling, you will recognize a cost of goods sold. So this together makes up your gain, and the asset in question is your inventory. So this is how the entry will look like. This is how the entry will look like. Basically, I have split up this profit and loss into the two constituents for a dealer or a manufacturer lessor. That is sales as well as COGS. Acha, theek hai. But now the question is, what will go in this sales? Will it be the same lease receivable amount which will go in the sales? Answer is no. Answer is no. Okay. What will go in here is the lease rentals, that the lease receivable amount which you have calculated, which includes the UGRV minus the unguaranteed residual value. You have to subtract it because that cannot be a part of the sale. That cannot be a part of the sale. And in the case of COGS, what is going to go? In the case of COGS, it is going to again be the normal cost that you are having, because you have deducted the unguaranteed residual value here, the present value. The same thing will be deducted here also. So ultimately what happens is your profit figure is not going to change. Only thing is, when you are recognizing the sale, you have to ensure you meet the requirements of Ind AS 115. And Ind AS 115 does not permit you to recognize unguaranteed residual value. Why? Because it does not represent your income today. It is a cash flow which you expect will arise in year 6, 7, 8 in our example. How can you book it today when you are making the sale in year 1? And therefore, to meet the requirements of Ind AS 115, lease rentals minus, sorry, not lease rentals, lease receivable value, whatever is there, from that you subtract the present value of unguaranteed residual value. Sir, if this is reduced, the corresponding COGS also you have to deduct that. So therefore, there also you will deduct the present value of unguaranteed residual value. Okay, so with that we move on to manufacturer and dealer lessor theory. I have just now explained why we need to do that. Okay, and with that, let us move on to illustration number 38. Okay, a dealer lessor enters into a 10-year lease of equipment with a lessee. Okay, the equipment is not specialized, expected to have an alternative use to the lessor at the end of the 10-year lease term. Under the lease, the lessor receives annual lease payments of 15,000 payable at the end of the 10-year lease term. The lessor expects the residual value to be 50,000 at the end of the lease term. Okay. Lessee provides a residual value guarantee that protects the lessor from the first 30,000 of loss for a sale at a price below the estimated residual value at the end of the lease term, that is 50,000. The equipment has an estimated remaining economic life of 15 years, carrying amount 1 lakh, fair value 1 lakh 11. The lease does not transfer ownership to the lessee at the end of the lease term. Neither does it contain an option to purchase the underlying asset. The interest rate implicit in the lease is 10.078%. How would the lessor account for the same in its books of accounts? Okay, so this is a manufacturer lessor or dealer lessor question. Okay, so now first thing is lessor's perspective. He is giving this asset on lease. That means he is going to get lease payments. So present value of lease payments. Present value of lease payments is equal to, first is the lease rentals plus you have the unguaranteed residual value. Okay. So lease rentals is what? 15,000 each year into, can I do present value annuity factor? What is the rate? 10.078%. 10.078% for 10 years. This is going to be the present value of lease rentals plus 30,000. 30,000. Wait a minute. Why 30,000? Lessee provides a residual value guarantee that protects the lessor from the first 30,000 of loss. From the first 30,000 of loss for a sale at a price below the estimated. Sorry, this should be the guaranteed residual value. Okay. So plus the first 30,000 is guaranteed by the lessee. So plus 30,000 into, here I can use a present value factor 10.078% for the 10th year. Okay, so this is what you are going to record. This is what you are going to record. Okay, so what will be the journal and what will be the figures? If you do it a little quickly, this should come to 6.1240. And this should come to 30,000 into 0.3828. Please confirm later on. Please confirm later on. Okay. So 15,000 into 6.1240 into 6.1240, 91,860 plus 30,000 into 0.3828. 11,484. 1,03,344. This is what is going to be your present value of lease payments. Okay. What is going to be? So we are testing whether this is an operating lease or a finance lease. What is the fair value? Fair value is 1,11,000. Therefore, present value of lease payments is going to be 93% of fair value. Hence, finance lease. Hence, it is a finance lease. Hence, it is a finance lease. Okay. 1,03,000 is almost 93% of fair value. That is substantially covering the fair value. Acha, sir, we have not taken the unguaranteed residual value. How can you take unguaranteed residual value? You can take unguaranteed residual value only if it is already a finance lease. Okay, we are yet to decide, and therefore we are now working on whether it is a finance lease or not. Okay, so therefore we have not taken the unguaranteed residual value. This is to decide, is it a finance lease or not. To decide this, we do not take the unguaranteed residual value into consideration. Now, once this is decided that it is a finance lease, we will then have to take the unguaranteed residual value also into consideration. Okay. Once it is clear that what the lessor is doing is a finance lease, we will now have to pass the entry. We will now have to pass this entry. Lease receivable account debit. So this lease receivable account should happen at net investment in lease, which is present value of lease payments plus unguaranteed residual value. Okay. So net investment in lease is equal to present value of lease payments plus present value of unguaranteed residual value. Lease payments present value is 1,03,344. Unguaranteed residual value, you can check here. Estimated residual value is 50. Protection is 30. So therefore unguaranteed is 20. So 20,000 into 0.3828. It is realized after 10 years. So present value factor of 10.078% for the 10th year. For the 10th year. Okay. So this gives you how much? This gives you 1,11,000 exactly. So now what is going to be your net investment in the lease? 1,11,000, which I will debit here. 1,11,000. Next is cost of goods sold, debit. Cost of goods sold, debit. Carrying amount is 1 lakh rupees. So therefore it is going to be 1 lakh minus unguaranteed residual value. Why unguaranteed residual value is deducted? Because I'm going to deduct it from sales. Why deduct it from sales? Because as per Ind AS 115, I cannot show this as revenue right now. So deduct it from sales also, deduct it from cost also. So this comes to how much? This comes to 92,344. Okay. Next one is to revenue. To revenue. Okay. So what is going to be the picture of your revenue? Well, revenue is 1,11,000 minus the lease receivable minus 7,656. That is 1,03,344. So you have recognized the profit to inventory or asset. जो बोलना है बोलो. 1 lakh. What is your net gain? Net gain is equal to 1,03,344 minus 92,344 is equal to 11,000, which is the same as fair value 1,11,000 minus cost 1 lakh. Okay, so this is how you will do the accounting. This is how you will do the accounting. Okay. All right. And then you will be collecting the lease rent year 1. You will collect the lease rent bank account debit. Kitna hai lease rent? 15,000. You will collect the lease rent 15,000 to finance income. Finance income is based on lease. So 1,11,000 into 10.078%. 11,187 to balance goes to the liability. That is the lease receivable for you. So that comes to 3,813. So basically interest will be recorded in each subsequent year. Net investment will ultimately have a balance of 50,000 at the end of 10th year, which will comprise of expected residual value. That is both UGRV of 7,656 Srinidhi is deducted from COGS and sales as per Ind AS 115 requirement. Okay. I cannot take this 7656 as my revenue. It is prohibited by 115. Prohibited by Ind AS 115. Why prohibited? It is a future cash flow. It is not related to the contract that you are having at hand, and that is why आप उसको नहीं ले सकते. You cannot take that into consideration. Okay. 115 requirement. Okay. So you deduct both revenue and COGS. If it was a pure lesser, you know क्या होता था? You would just take inventory 1 lakh and show balancing figure 11,000 as gain. Baat would get over. The story would get over there itself. But because this is a manufacturer or dealer lesser problem, you need to show revenue also. You need to show the cost of goods sold also. So the difference would be a mirror of the profit that is generated. Okay. Have you understood? Others, Sheena Jain. Got it? Anybody has any doubts in manufacturer and dealer lesser? Got it now. Okay. Sheena Jain, Priya Garg, Mahinder, Suraj, Vidula. Ayush is not there. Tanushri. Today nobody spoke also much. Srinidhi has confirmed. Others? Clear. Vijay Rajeshri. Oh, acha. Good to see some familiar faces. I mean, not familiar faces, but familiar names. Okay. All right. So this takes care of basic lesser accounting. Okay. There are 2 to 3 small questions in the study module which are based only on theory relating to lesser and lease modification. We'll do lease modification. Then I want you to just try out those questions by yourselves. Okay. We then move on to certain special cases. Okay. Now some are very simple, but one case is very, very tricky. So I will be doing that right now. Okay. Please pay attention. All your focus should be on these, because now what we are touching is highly probable that it would have exam implications because of the sheer complexities of it. Basically, 2 things are highly probable in the exam. First is your sale and leaseback, which I'm going to do right now. And the second one is your lease modifications or reassessments. Reassessment question has already come. So it is likely that you may have a lease modification question that may come in the next attempt, or there is a chance that you may have the special amendment that came on account of COVID-19. There is a chance that you may get a question from that. Okay, so that is why it's very important that you pay attention now. Whatever we have done so far should help you speed up the understanding process now. Okay. So now, first case is a sublease. What is a sublease? There is an original lessor. The original lessor gives it to the original lessee, the asset on lease, and the original lessee will further give it on another lease. Okay, so I am having something known as a head lease, which is the original, the first transaction, and from the intermediate lessor or the original lessee to the sub lessee, I'm again giving it on lease. So therefore this is what is going to be your sublease. Now accounting for original lessor is not a problem. Why? He will always be a lessor. He will always be a lessor. Or if it talk about a reporting entity, it will always be a lessor. Accounting for a sublessee will not be a problem because it will always be the lessee. So it will apply the ROU, the ROU asset lease liability accounting, or if it wants to go for optional exemption, it can go for the optional exemption. The problem arises with the middle fellow. The problem arises with the middle fellow. Sir, why problem? Well, for the first leg of the transaction, he is a lessee. That means he may apply ROU asset lease liability. He may apply an optional exemption. And the next one is he is giving it on lease. That means he also becomes an intermediate lessor. So if he has to be an intermediate lessor, he has to decide whether it is a finance lease first or an operating lease first. So therefore you have two things, two hats in the role of on the head of the middle person. Okay, so how do I do this accounting? So first thing is you have to assess whether the sublease is an operating or finance lease. Who has to assess this? The original lessor? No, it is the intermediate lessor who has to assess whether the sublease is a finance lease or an operating lease. What are you going to compare? Okay, see, you have to compare if it is leased for a major portion of major portion of the life of the lease term. So of the life of the economic asset. So now what will be the life of the asset? Will it be the original tenure or will it be the life of the ROU asset? It will be the life of the ROU asset. That is the original lease term. The asset's useful life may be 40 years, but you may have taken the asset on lease for only 10 years and you are giving this asset on sublease for 9 years. So you are giving this asset on sublease for 9 years out of the 10 years that you're holding. You cannot say I gave the asset on lease for 9 out of 40. Are 40 to asset is not going to be there with you in the first place. After 10 years, you have to return. So for you, the life of the asset is not 40, it is 10 years. As compared to 10 years, if you have given it on lease for 9 years, then that means it is for a major period of economic life of the asset, and accordingly you will take it as a finance lease. Okay, so compare the sublease term with the life of the ROU asset. First point. Second point, when the head lease is a short-term lease, that means this is less than 12 months. Obviously ना sublease also is going to be less than 12 months. ऐसा थोड़ी हो सकता है that you have 12 months head lease and 10 years of sublease. जितना टाइम आपके पास प्रॉपर्टी रहेगा उतना टाइम के लिए ही तो आप रखोगे ना sublease. What is the time you are allowed to have the head lease? Only for that time you can give on a sublease. So if this is a short-term lease, this also is going to be a short lease and therefore it will always be classified as an operating lease. Is it a rule? No, this is mere clarification. This is a mere clarification, nothing else. Okay. An intermediate lessor cannot account for the head lease as a lease of low value asset irrespective of the value of the item. You cannot take the what you can say, you cannot take the recourse that this is a low value item and accordingly you cannot take the exemption. So therefore an intermediate lessor cannot account for the head lease as a lease of low value asset. So what is the entry that you are going to pass? Suppose your sublease is an operating lease. You took the asset on lease. You are having ROU asset to lease liability. You are having this entry. Now the question arises, how will you account it? Operating lease, that means I am not transferring the asset, so therefore no entry at the time of sublease. ROU asset and lease liability both will continue to be recognized. Simple enough. Yes. Recognize rental incomes depending on a what you can say, recognize the rental income on a systematic basis. If that is not there, on a straight line basis. So wo ho gaya operating lease. If sublease is a finance lease, then that ROU asset you have to give up. So credit ROU asset, debit lease receivable, and then you could have a gain on sale which goes to your P&L. So this is what is your accounting. ROU asset you had received. So ROU asset to lease liability. To lease liability. Now this ROU asset is getting transferred here, but lease liability is getting affected. No, original lease liability is not derecognized. Is not derecognized. Is it understood? Yes. Sure. Have you understood accounting for a sublease? Can this happen that head lease is an operating lease and sublease is a finance lease? It all boils down beta on how original lessee does the accounting. The original lessee must always recognize it as a lease in which there is an ROU asset and a lease liability. If there is a lease where the original lessee or intermediate lessor recognizes it as an ROU asset, then definitely you can have a finance lease for the sublease. No doubt in that. No doubt in that. Okay. All right. So that is definitely going to be possible. That is definitely going to be possible. Okay. Any other doubts? Sheena Jain, understood? Yes. Got it. Srinidhi has confirmed. Vijay Rajashri, Priya Garg, Mahinder ho to jawab dena. Okay. An intermediate lessor cannot account for the head lease as a value of low value, as a lease of low value asset. That means it has to recognize it as an ROU asset and lease liability unless it is a short-term lease. Unless it is a short-term lease. Okay. Okay. So pick up these two, three questions for homework. It is only theory. I leave it to you for homework. Okay. All right. I leave it to you for homework. Okay. All right. Just give me a minute. I'll come back. Okay. If there are any doubts, please feel free to revert. Okay. I'll come back in a minute. Okay. Give me a minute. Hello. Yes. Sorry for that. So coming back to the next and an important part, but little bit complex, but not very difficult. Okay. So now coming back to sale and lease back. So I hope sublease is clear to everyone. Coming to sale and lease back. Sir, how is it possible that if head lease is operating, this means that asset must go back to the lessor, even if the sublease is a finance lease, which implies the asset should be retained with the lessee? Sheena Jain, see, we are making a mistake in understanding the concept of finance lease. Finance lease does not necessarily mean, okay, now let me help you with that. Original lessor, original lessee, intermediate lessee, and sublessee. Okay. Now you are saying that this lease is operating lease. Okay. So if this is an operating lease, the asset would remain here with the lessor. Yes, but suppose the original lessee does not avail any optional exemption. That means the original lessee will record ROU asset to lease liability. Yes, he will record an ROU asset to lease liability. Now, suppose if there is a transaction between the original lessee and the sublessee, suppose this transaction was for a period of 10 years, and now the sublease is for a period of 9 years. At the end of 9 years, the asset reverts back to the original lessee, and after 1 year from there, it reverts back to the original lessor. Now, can the original lessee classify this asset as a finance lease? Can the original lessee classify it as a finance lease? Yes, he can. Why he can? Because what is being transferred is not the original asset. Original asset is with the lessor only. What is being transferred is the ROU asset, which is the right in that asset which is present with the original lessee. So therefore, when I talk about finance lease between the what you can say intermediate lessor and the sublessee, it is a finance lease classification with reference to the ROU asset and not with reference to the original asset You spoke that finance lease means the asset must be retained by the lessee. Never. I never told you that in a finance lease, the asset must be retained with the lessee. What happens in fact is that many cases you may have the useful life of the asset as 10 years. You take the asset on lease for 9 years, and after 9 years, you give the asset back to him. Are you retaining it? No, you're not. But in the end, are you keeping the asset for major portion of economic life? Yes. So therefore, the lessor can very well classify it as a finance lease. But whatever the lessor does is only lessor's accounting. The lessee has to ultimately treat it. As an ROU asset and a lease liability with only those two cases of optional exemptions of short small value items as well as of short lease terms less than 12 months. Otherwise, ROU asset lease liability accounting is mandatory. Okay. So when I talk about finance lease in a sublease, it is not with reference to the original asset. The original asset might still remain with the lessor, but the original lessee or the intermediate lessor would record an ROU asset. This ROU asset would have a life of 10 years. But you are subleasing. That means these right to use this asset, you are giving it to somebody else for a period of 9 years. So are you giving this asset, which is the right, for a substantial portion of the economic life? Definitely you are. In that case, can the intermediate lessor recognize it as a finance lease? Yes, he can. What is going to be transferred is the ROU asset. Look at the journal entry. Look at the journal entry. The entry is lease receivable account debit to ROU asset. It's not the original asset that is going out. It is the ROU asset that is going out, because original asset to uske paas hai hi nahi na. He does not have the original asset, and afterwards the ROU asset will revert back. Afterwards the ROU asset will revert back to the original lessee. So for the revert back of the original asset, it is going to be ROU asset account debit to lease receivable. When will this entry be passed? At the end of 9th year. At the end of 9th year. Are you convinced, Sheena Jain? Are you convinced? How is it possible? If head lease is operating, this means that asset is with the lessor, kahin gaya hi nahi hai, even if the sublease is finance. Okay, so Sheena, are you clear? I hope you have understood. Okay, I hope you have understood. Okay, so I'll wait for a minute or two until she gets it. Others, did you understand sublease? Srinidhi has confirmed. Okay, sir, I understood. Okay, I hope I have been convincing for you. Okay, so now coming back to sale and leaseback. What is sale and leaseback? There is an entity. It has an asset. It sells that asset and takes it back on lease. So transfer of asset by one entity to another. What do we call this entity? We call it as the seller lessee. And lease back of the same entity by the original entity. Sir, so why do they do this? For immediate cash requirements. Okay, suppose you need cash immediately, you don't have the cash, but you have a very pristine asset. You cannot bear to depart with that asset. Okay, it is a heartbreaking thing for you. So what you do is that you sell that asset with a condition that you will have to lease back the asset immediately. So that what happens in that case, you get cash on sale, and then you pay off the lease rentals over the lease tenure. Okay, so basically your office is, if it is an office space, your office was there when you owned the land. When you sold the land and took back the office space, that property, then also your office is there only. There is no change in that. Only thing is you have structured the deal in such a way that you are left with cash by kind of monetizing your asset. Okay, so now when you talk about sale and leaseback, there are two situations which happen. First thing is, in the sale that you have made, control is not transferred. Control aapke paas hai. You have not made a sale deed, you have not transferred anything. Control is with you. So therefore you are the owner. Risk rewards incidental to ownership are with you. Everything is with you. So therefore, when this is the thing, what have you transferred is a mere what you can say is a mere whitewash. Okay, it's an eyewash. Lagta hai kuch transfer hua, but nothing is transferred. So therefore, this transaction would be treated as a loan transaction. This transaction would be treated as a loan. It is as if you have taken a loan. So the entry would be bank account debit to loan account. Neither is the asset derecognized nor is the gain or loss on sale recorded. Okay, so this is how it is going to be recorded. Okay, you will treat it as a loan. This is not so important. Okay, this is not so important. What is important is when control is transferred. When control is transferred, you will account it as a sale. And then there is a lease back. So when you record it as a sale, you will derecognize the underlying asset and record a proportionate gain or loss. So what is proportionate? We will do it with the help of an example. Okay, we will do it with the help of one of the problems only, so that it makes the things fairly simple. Okay. You can also understand better. At the same time, the question also gets solved. Okay. So now an entity sells a building to another entity for cash of rupees 30 lakhs. Okay. So the sale consideration of building is 30 lakh rupees. Immediately before the transaction, the building is carried at a cost of 15 lakhs. So I have here 30 and carrying amount of building is 15 lakhs. At the same time, the seller lessee enters into a contract with the buyer for the right to use the building for 20 years with annual payments of 2 lakhs payable at the end of each year. So he has sold it and at the same time taken it on lease, taken it back on lease. Okay, fine. The terms and conditions of the transaction are such that the transfer of the building satisfies the requirements for determining when a performance obligation is satisfied in Ind AS 115. Be careful. This is not recognizing sale of asset as sale of goods. Okay. Basically, in Ind AS 115, they have given detailed guidance which states that in respect of sale of goods, when is your performance obligation deemed to have been completed? So based on those guidelines, your obligations here are completed, so you can recognize the sale. You are not recognizing revenue. You are meeting the performance obligation requirements in Ind AS 115, which is why you can recognize the sale of the asset in this case. The fair value of the building is rupees 27 lakhs. Okay. So now the question is 27 lakhs. Now you tell me, why will a person, a third party, give you more money? Why will a third party give you more money? Fair value is 27 lakhs. Sabko pata, if they are buying goods from the market, then they will definitely know what is the market value. So why are they willing to give you more than the market value? It is because, think it of like this. The seller, lessee, requires 30 lakh rupees. वो बोलता है मेरे को कैसे भी करके I need 30 lakhs. But the asset which he is having is worth only 27 lakhs. So what he tells to the buyer is, look, you give me 30 lakh rupees. But buyer will tell, Dek, but fair value is 27. Why should I give you 3 lakhs? Then the seller will tell, look, you give me 30 lakh today. In effect, you are giving me 3 lakhs extra. In effect, you are giving me 3 lakhs extra. This 3 lakhs, I will repay you in the future. What am I doing? I am taking this on lease from you, no, for the 20-year period. You charge me extra lease rentals. You charge me extra lease rentals. So therefore, in the manner, in the form of extra lease rentals, suppose the market rent is 1,80,000. For example, you charge actual rent as 2 lakhs. That means what? I am paying you every year 20,000 into 20. That means I would have paid you 4 lakh rupees over the 20-year period, to which the buyer will agree. To which the buyer will agree. So therefore, the standard requires us to treat this excess 3 lakhs as a hidden financing component. How is this hidden financing component being repaid later on? It is being repaid in the form of excess actual rent over market rent over the lease term. Excess actual rent over market rent in the lease term. Okay. So now you can look at the theory which is there. This transaction involves a hidden loan arrangement which contains a repayment in the form of excess lease payments. You will pay more than the market value in the form of lease payments, and that way you are also paying off the lease, the finance component that is there. So therefore, this 3 lakhs is a hidden financing component. Okay, so this is the first point. Let us then move further and look at what the question is telling us. Okay. Initial direct cost, if any, are to be ignored. The interest rate implicit in the lease is 12% per annum, which is readily determinable by the seller lessee. Buyer lessor classifies the lease as an operating lease. So how should this transaction be recorded by the seller lessee and the buyer lessor? Okay, fine. So now pay attention. You are giving this on annual lease payments of 2 lakh rupees payable at the end of each year. What is the discount rate? The discount rate is 12% per annum. The discount rate is 12% per annum. So ideally, what should be the present value of total lease payments? Sir, just take 2 lakhs into the present value annuity factor of 12% for 20 years. 12% for 20 years. So that comes to 7.5894. You do the workings, you will come to know. Okay, understand the concept. Workings to aap log fir bhi kar doge. You will be able to do the workings. Okay, so that comes to 14,93,888.72. That means in today's terms, you are going to pay 14,93,888. आज के terms में you will be paying 14,93,888. But in today's terms only, you have received a financing component. Yes. So in effect, when you are paying 14,93,000, it also means that you will be paying towards this financing component, and therefore the standard tells that you will reduce the hidden financing component to arrive at something known as dedicated lease payments. To arrive at something known as dedicated lease payments. What do you mean by dedicated lease payments? This 11 lakh is purely your lease transaction. This 11,93,888 is purely your lease transaction. And therefore, 3 lakh rupees, what is the difference, is the hidden financing component. In other words, when you pass the journal entry, this will be a financial liability. This will be your lease liability. This will be your lease liability. So what will be your journal entry? I will look at it part by part. First is bank account debit. You are getting 30 lakh rupees. So 30 lakhs debit. Second is your financial liability, 3 lakh rupees. Okay. Third is your lease liability, 11,93,888. Fourth is building is going out. You're selling the building. So this is the WDV of the building, 15 lakhs, which is given to you, here. The building is carried at a cost of rupees 15 lakhs. Okay. So these ticked items, we came to know what is the amount and from where it is coming. Now pay attention. Now please pay attention. See, ideally, whatever was the lease liability should have been your ROU asset. Sab kuch normal hota tha. If everything was normal, this should have been your ROU asset. But now understand the transaction. Understand the transaction very carefully. Okay, this part is very important. This part is very tricky, and therefore I need your complete attention here. Okay, ideally this would be the case. Okay, ideally my ROU asset would be 11,93,000. But when would this be 11,93,000? If I had to take only an asset on lease and not a sale and lease back. Not a sale and lease back. Likewise, ideally my sale value is how much? My sale value is 27 lakhs. But sir, the sale value is 30, no? Nahin, 30 is total, but out of 30, 3 lakhs is financing. So your sale value normal is 27 lakhs. So ideally, you should have booked a profit of 12 lakhs. Sab kuch normal hota. If everything was normal, I would have an ROU asset of 11,93,000 and a profit on sale of 12 lakhs. Supposing that what I sold was different, what I got was different. If they are two separate transactions, I would book a sale of 27 lakhs and get 12 lakhs. And I would recognize a lease liability of 11,93,000. Suppose you somehow manage to convince the buyer to pay you more than the fair value, even then you would, that point also you would take it as 30 and you would book this as 15 and you would take this as your ROU asset and corresponding liability. But yahan pe that is not happening. Here that is not happening. Here what is happening is the asset that you gave, the same asset is coming back to you. That means the book value of your asset is 15 lakhs. Now the book value of asset is 15 lakhs. The fair value of this asset is 27 lakhs. That means if you would pay 27 lakhs, you would get the rights as strong as that of the owner. You would get rights as strong as that of the owner. The important part to note here is I am selling this asset, but ultimately it is I and I myself who is retaining this asset. So I am retaining some rights of that asset. The value of the rights which I have retained is 11,93,888. The value of this right which I have now retained is 11,93,888. My seller, my buyer has paid me 30. Out of 30, 3 lakhs is kept out as a loan transaction. So therefore, somebody interested in buying would pay 27 lakhs for an asset to get the rights as strong as that of the owner. However, I am now taking back this asset on lease. That means, am I parting away with all the rights in this building? There are rights relating to my ownership, rights relating to right of use, rights relating to all these things when I am the owner. I am giving away the ownership rights and I am retaining the right of use rights. Tomorrow, if the asset is sold, who will get the proceeds? The buyer will get the proceeds. So ownership rights I have transferred to him. But presently, who has the rights? Who has the right of use? I have the right of use. What is the value of that right of use? The value of that right of use is 11,93,888. So correspondingly, how much ROU asset can you recognize? You can recognize a simple cross multiplication. 15 lakhs 15 lakhs into 1193,888 divided by 27 lakhs divided by 27 lakhs. This is the value of ROU asset that you are going to retain. You sold book value of 15 lakhs. That component had a fair value of 27 lakhs. Against that 27 lakh fair value which you sold, you have taken it on lease, for which the fair value component is 11,93,888. And for this 11,93,000, the corresponding ROU asset that you are going to retain is 6,63,271, which is a simple cross multiplication. So you cannot recognize the entire ROU asset. Why? Because you were the owner, you are entering into dual transactions. एक तरफ loan है, दूसरी तरफ lease है. You have a loan on one side, a lease on other side. So you cannot recognize entire 11,93,000 as your ROU asset. So right now you are going to recognize the ROU asset of 6,63,271, which is exactly what is the meaning here. Okay, which is exactly what is the meaning here. De-recognize the underlying asset and record the gain or loss on a proportionate basis. So if I talk about proportionate basis, what does it mean? It means total gain on sale is 12 lakhs. Why 12? Why not 15? 3 lakhs is the financing component. So proportion of rights retained is out of 27 lakhs of complete ownership, I am retaining the rights of 11,93,888.72. This is the value of the rights, the fair value. Okay. And therefore, this much is the gain. This much is the value of rights which I have retained. So proportion of rights transferred is giving me a gain of 6,69,382. So this is what is the proportion of rights which I have transferred. Out of 12 lakh gain, 5,30,000 worth of gain is there with me only. I am retaining in terms of fair value this profit. Why am I retaining this profit? Because asset is with me, right of use is with me. It is only a mere cash arrangement which we are doing right now. Okay, so therefore 5,30,000 to mera hi hai. I will not recognize a profit out of this. I will recognize a profit on what I have transferred, which is 6,69,382.79. So now when I do the final journal entry, it is going to look something like this. The building which I am retaining is going to come at 6,63,271. However, this building is going to be an ROU asset, not an building, because now I'm not the owner. So therefore, you can see the carrying amount was 15, but what I'm getting in return is 6,63,000. Why this value went down? Arey Baba, I'm not the owner. And when I'm not the owner, how can I retain at 15 lakhs? I only have right to use the asset. I don't have the rights of an owner now. Mere rights mein kami ho gayi. My rights have diminished. My rights have fallen down. And therefore, I am going to record it at the proportion of rights retained. And finally, you have the gain on transfer of rights, which goes to your P&L. Alternatively, you calculate all of this, and this can be taken as a balancing figure. So this is what is the entry that you are going to do in the case of a sale and leaseback transaction. In the case of a sale and a leaseback transaction. And now, every year, now there is a problem. Now, please bear with me, put some stress on your heads for today. Okay, I will not be there to trouble you for the next couple of weeks. Okay, so let us complete this. Okay, total lease payment made for 20 years is 2 lakhs per annum. Okay, you are going to make a lease payment of 2 lakhs per annum. Now, this 2 lakhs goes towards satisfying two people or two liabilities. It goes to satisfy my lease liability. it goes to satisfy my financial liability. And therefore, 2 lakhs, out of 2 lakhs, your total liability was 14 lakhs 93,000, out of which 11 lakh 93 is lease. So out of 2 lakhs, 1 lakh 59 goes towards the lease component, and 2 lakh goes out of 2 lakh, 40,163.63 goes towards your financial liability component. So this is the split that you are going to do. The question stops here. The question ideally stops here, but I have just proceeded further to explain to you how the amortization of lease liability as well as the financial liability happens over 20 years. So lease liability, it starts off with 11 lakh 93. What is this 11 lakh 93? It is present value of dedicated lease payments. Okay. So that is what is the present value of this 11 lakh 93. The interest is at the rate of 12%. Look at the repayment figure, 1 lakh 59,836, which is nothing but the split that I have given. And now this over a 20-year period, ultimately it becomes zero. Ultimately it becomes zero. This is the interest that you will be booking at 12%, which is the rate that they have given. If you take the financial liability, which is the 3 lakh financing component, you start off with 3 lakhs. Repayment is 40,163, which is this figure. And when you ultimately move after 20 years, you will see that this value also becomes zero. So this is how a sale and leaseback transaction will be recorded. It will be recorded in the books of the lessee. In the books of the lessee. Sir, what about in the books of the lessor? Lessor ke books mein it's quite simple. The entry is going to be lessor is buying the books. So this is in the books of lessor. Building account debit 27 lakhs fair value. To bank 30 lakhs. And what is he going to do with this 3 lakhs? Array, there it is a financial liability. Here it is going to be a financial asset. Here it is going to be a financial asset. And the same way how they have recorded, you will also start to record the asset as well as the liability. You will also start to recognize the finance income as well as repayment towards the financial asset. Okay, so this is exactly how you will do the accounting for the lessor. Okay, so now with this background, let us come to the theory. So control is transferred, de-recognize underlying asset, record gain or loss proportionate. Which proportion? The proportion of rights transferred. The proportion of rights transferred. Okay. When the sale happens at off-market terms, in our example, it was at off-market terms. Selling price 30 lakhs, 27 lakhs is your fair value. So that is an off-market term. The adjustment will have to be made for difference between fair value and selling price. In our example, fair value was 30 lakhs. Fair value was 27 lakhs. Selling price was 30 lakhs. So we took 3 lakhs as the financing component, or the difference between present value of contractual lease payments and present value of fair lease payments. See, if this data is not given, fair value of the building is not given, but this data is given, then whichever is more readily determinable. Okay, that means you are given contractual lease payments, which would normally be higher in a financing arrangement. Fair lease payments would be lower. Take the present value of both of them. The difference would represent a financing arrangement. The difference would represent a financial liability. So whichever is more readily determinable. Okay. And then suppose if it is at off market terms where the selling price is greater than fair value, or or if this is not determinable, this one, present value of actual rent is greater than the present value of market rent. That means you are paying more. You are paying more. Why you paid more? Because you have taken more when you sold it. Okay. So this transaction contains a hidden loan arrangement which involves repayment in the form of excess lease payments. What are you going to do? Reduce the selling price by the loan element. Reduce the selling price by the loan element, which is exactly what we have done. Selling price is 30. Loan element is 3. So 27 lakhs is the fair value. And we have recognized our, what you can say, building 30 lakhs, and we have adjusted the 3 lakhs here. So net is 27 lakhs. Okay. So that takes care of this part. All right. Sir, opposite ho sakta hai. Can it be opposite? That means fair value is 27 lakhs, but I collected 24 lakhs. It can happen. Suppose there is a lessee, a buyer who is very much interested in your property, but today he does not have the money. And today for some reasons you need cash, but you don't need very high cash. Okay. Immediate requirement of cash is there. So how are you going to structure it? You will tell, Acha, you want to pay 24 lakhs, you pay me 24 lakhs. In the future, I will pay you lease rent lower than the market value. I will pay you lease rent lower than the market value. So therefore, in this case, the transaction contains a hidden prepaid rent or lease payment arrangement. And this is adjusted in the future against reduced lease payments. There you took excess lease payment was adjusted against financial liability. Here, whatever is the reduced lease payment, you will add the payment made to equate it to the market rent and adjust it against the prepaid rent. You will increase the selling price by the prepaid element with a corresponding adjustment to the ROU asset. So this kind of takes care of sale and leaseback. I have given the steps for you when selling price is greater than fair value. And here also I have given the accounting when selling price is less than the fair value. So this kind of takes care of sale and leaseback. Okay. So I was a little bit fast, but I think you should. Thank you, Sheena. She left at 10:40. Okay, no problem. Others, did you understand the problem? See, the theory part you can definitely go through, but did you understand the problem is what is important. Some small tidbits here and there are going to be there. Okay. So you can always remain in touch with me. But the thing is, broadly, if you have understood it, the small nitty-gritties, we can sit and sort it out later. Okay. So that takes care of leaseback and sale. Okay. All right. What I will do is, there is this transition approach. I will leave it with you for homework. It is quite simple. If you have understood lease asset, lease liability accounting, I will leave this with you for homework for two reasons. First one, all the balance sheets transitions have already happened on 1/4/2019. So you getting a transition question is a little bit remote is what I feel, but nonetheless, it's there in your study module. And because it is there in your study module, I have put it. I will also be sharing the transition question for you. Okay. I have the solution. You may find the institute solution a little bit, I won't say incorrect, but the way we do the formats we do, it is a little bit different from that. So I have given how the presentation is to be done in the financial statements also. So I will leave this right now at this stage because, I do not find it necessary to spend a lot of time on transition right now. Okay. We shall move on to lease modifications. What is lease modification? It is a change in consideration, tenure, or scope. That means either lease rent increases or decreases, tenure means lease term increases or decreases, or scope, change in area of property taken on, lease. Either of these things can happen, and these changes happen after the lease commencement. After the lease commencement, words pe dhyan do. That means when you are modifying the lease, there is already an existing ROU asset and an existing lease liability already present. So now you are modifying it, and therefore there is a change in either of these three things. How are you going to modify? First thing is, you could account for the modification as a separate lease. For example, you had taken 1000 square meters property on lease. You had taken 1000 square meters property on lease, and from the same lessor, you are taking an additional 500 square meters. You are taking an additional 500 square meters on lease. For some reason, you agree that chodo, we will not make a new agreement. We will continue in the same agreement itself. Okay. So this is a lease modification. You are already having an ROU asset for 1000 square meters, lease liability for 1000 square meters. Now you have entered into a further lease arrangement for 500 square meters. So what the standard tells is, you could treat that 500 square meters as a separate arrangement if two conditions are fulfilled. Additional right of use is obtained. Additional right of use obtained. This extra 500 square meters is additional right of use. Pehle I had 1000, now I am having 1500 additional right of use. And the additional right of use is commensurate with the standalone selling price. Whatever is the market price of 500 square meters, the same price is charged from you. Because you are an existing customer, there are no special discounts given to you. Okay, you are treated at par with market price. Reasonable discounts are permitted. For example, you do not have to pay for brokerage. You do not have to pay again for lease rent. You do not have to pay for advertisements. You do not have to pay for scouting for lessees. So all these give rise to some discounts. Those are permitted. Otherwise, in a broad picture, you are getting extra asset. For that extra asset, the consideration is comparable to standalone prices. If these two conditions are identified and satisfied, then you will treat it as a separate lease. And separate lease means separate ROU asset and a separate lease liability. Important thing is, existing lease accounting for this 1000 square meters will not be altered. It will not be altered. वो वैसा ही रहेगा. You will record the additional 500 meters separately. Okay, so this is simple. You will treat it as it is. This is a theory question, so I'm leaving it for homework. Suppose now, if it is not a separate lease, that means the changes have not happened at standalone prices or whatever be the case. Okay, how are you going to treat it? If there is a change in consideration, it could be increase or decrease. If there is an increase in the lease term, or if there is an increase in scope, area has increased but not at standalone price, or lease term has increased not at standalone price, then you will remeasure the lease liability with a corresponding adjustment to the ROU asset. It is as if lease term increased. Now it was 5, now it became 8 years. So you got an extra right of asset for 3 years, or right of use asset for 3 years. Scope has increased from 1000 to 1500. You got extra 500 square meters. So that is like an extra right of use that you got. Change, increase or decrease. It is as if your existing right of use became costlier or it became cheaper. So in all these cases, modification will be to lease liability with a corresponding change in the right of use asset. No gain or loss will arise here because this is tantamount to purchasing an ROU asset. It is not tantamount to selling the ROU asset. The ROU asset sale appears to happen when there is a decrease in lease term. I had a lease term of 8 years. Now I'm modifying it to take only for 5 years. So I have sold my right of use asset for 3 years. You can take it like that. I had the lease agreement for 2000 square meters. I gave up 500. I'm now happy with 1500. So I'm giving up the right of use asset of that 500 square meters. So in this case, you will proportionately recognize the lease, de-recognize the lease liability and the ROU asset. And because you are giving up a lease liability and an ROU asset proportionately, there will be a gain or loss which goes to the P&L. This appears as if it is a sale of ROU asset in the form of a reduced lease term or in the form of a reduced scope. Okay, so this is the treatment. What I will do is, I have done this for you. I will be doing questions where there is a gain or loss. Okay, because that is the more complicated one. Okay, so we come to illustration number 35, or even 36 appears to be fine. 1 minute, please. We will do illustration number 35. Illustration number 34. Implicit. This is extending the contractual lease term. Okay, increase in lease term. This is to reduce the lease payments. Reduce lease payments. So this is all falling in the side where your asset gets affected, no gain or loss recognized. So this I am leaving for homework. Do it after you revise the problem, which I'm going to cover up now. And we will do illustration number 35. Okay. Lessee enters into a 10-year lease, 5,000 square meters, annual lease payment 50,000, payable at the end of each year. Interest rate cannot be readily determined, so therefore incremental borrowing rate is 6%. At the beginning of year 6, they agree to amend the original lease to reduce the space to only 2,500 square meters. So original case kya tha? What was the original scenario? The original scenario was 5,000 square meters, 50,000 rupees, 6% per annum. Modification, at the beginning of year 6, it is 2,500 square meters at the rate of rupees 30,000. So your asset went down. The area that you have taken has gone down, but your lease rentals did not go down by corresponding area. It will generally fall down by, it fell down by a little lower. That means you are paying more for lesser area. It is as if your asset became, more valuable. Okay. And the revised lease term is, the revised discount rate is 5%. Okay. 5%. The annual fixed lease payments are 30,000 at the beginning of year 6 is 5%. How should the said modification be accounted for? So first thing what you are going to do is calculate the original lease liability. Okay. So original lease liability was 50,000 for 10 years at 6%. 50,000, 10 years, end of each year at the rate of 6%, it comes to 3,68,000. Or you can do PVAF calculations also. I have shown you. The change is happening at the end of the 5th year or at the beginning of year 6. So you can check, I have highlighted, you can amortize the lease liability. At the end of 5th year, your lease liability is 2,10,618, which is exactly what it will be at the beginning. Usme koi change nahi hoga. So original liability on date of modification is 2,10,618. Alternative calculation, you could take it as a PVAF also. The choice is yours. Likewise, you have to now calculate the ROU asset. Your ROU asset was corresponding to lease liability 3,68,004. 5 years have gone, so now it is worth 1,84,002. You have depreciated for a 5-year period. Proportionate decrease is 50%. So your reduction in lease liability is 1,05,309. If your area went down, your lease liability also should go down by same percentage. So 2,10,000 into 50%. And your ROU asset should also go down by the same percentage. And therefore, lease liability going down, liability is reducing, so debit the liability. ROU asset is reducing, credit the ROU asset. Whatever is left is 13,308, which is a balancing figure that goes into your P&L. Beginning of year 6, the balance of lease liability will be 1,05,309 and balance of ROU asset will be 92,001. Okay. What about the revised lease liability? Now, this was the lease liability on account of decrease in scope. At the same time, my consideration has gone up. It should have been 25,000. It is 30,000. Lower value, lower area, higher rent. So your asset, ROU asset has become costlier. So therefore, for years 6, 7, 8, 9 and 10, you will pay 30,000. But discounting will be 1 year from end of year 6. 1 year from end of year 5, from end of year 6. So therefore, discounting factors at 5% will be this. So it comes to 1,29,884. And this 1,29,884 is the modified liability on account of increased consideration. Your original liability was 1,05,000. Now it is 1,29,000. So therefore, this is 24,575 increase. Your original liability was 1,05,000. It went on to 1,29,000. This increase is on account of increase in consideration. It went to 30,000. 50 area dropped down by 50%, but consideration dropped down only by 20,000, not 25,000. Consideration dropped by 40%. So existing 50%, you are paying 60% of the total rent. So your asset became more costly. So therefore, the entry is going to be ROU asset account debit to lease liability. This is what you will be passing. Okay. So that is about lease modifications. Okay. All right. So that takes care of 35. 37. I want you to try out 37 also by yourself. Okay. In this case, there are two things. Scope is increasing as well as decreasing. Okay. So increasing means 2,000 square meters plus additional 1,500 square meters. Lease term has gone down from 10 years to 8 years. So therefore, if you look at the tenure, original lease liability comes to this. The modification is happening at the beginning of year 6. So therefore, your original lease liability is 4,21,236 on the date of modification. ROU asset is 3,68,000. Now, when you are reducing the lease term from 10 years to 8 years, that means remaining lease term is reduced from 5 to 3. It means you are retaining some of the asset, some of the liability. You are giving up some of the asset, some of the liability. So ROU asset, you are retaining for 3. Earlier it was 5. Now it is 3. You are surrendering 2. Likewise, lease liability, you are retaining it for 3. You are surrendering it for years 4 and 5. So you will de-recognize asset of 1,47,000 and de-recognize liability of 1,53,000. Net result is a gain which goes to your P&L. Okay. And finally, increase in scope. 1,50,000 became your new liability as per the question. 1,50,000 is now payable. Earlier it was 1,00,000. So therefore, 1,26,346 will be the value of the liability, and the ROU, the increase will happen to 1,26,000, which is equivalent to purchasing a new asset, that is additional ROU of 1,500 square meters. So this takes care of modification. Okay. ROU asset also will be modified to be depreciated over remaining 3 years. Okay. That takes care. Remeasurement is that variable lease payments. I will leave that for homework. I'll share the solutions with you. Okay. And last thing is a practical expedient that was introduced by MCA by its amendment on 24th July. Okay. So MCA, why its amendment dated, I think, 24th July 2020. See, the standard came into force in the year 2019-20. Unfortunately, COVID also came into force in 2020 March. So we had an amendment to this standard. This standard gave us a practical expedient, Now, what do you mean by practical expedient and why it was given? Okay, the practical expedient arises if the following conditions are met. Okay, first thing is there is a rent concession. Rent concession could be either in the form of decrease in rent or waiver of rent or deferral of rent, but not an increase, So rent concession on account of COVID-19. All right. So you got a rent concession. Second one, the revised consideration is substantially the same as the original consideration or lower than that. Revised consideration is less than or equal to original consideration. It cannot be more. So this part is most important. It is less than or equal to original consideration, cannot be more. The third condition is the rent concession affects lease payments up to, they have to give a deadline. So up to 30th June 2021 and no other substantive changes. If this is the case, then the practical expedient will be applicable. You have a choice. Now, what is the practical expedient? See, when you do the modification questions, you will see that we have to take the revised discount rate. We have to take the effect to the ROU asset, the effect of modification, and therefore ROU asset depreciation and all will also undergo a change. The practical expedient has given two relaxations. If these conditions are met, you can take the discount rate at the time of commencement, on the date of commencement. No need to find out a new discount rate. Academically, it is easy. You are given the discount rates, but practically it is a hard work to find a new discount rate. So practically you follow the old discount rate, and any change in the lease liability, it will happen because you are waiving off, you are deferring, you are doing so many things because of COVID-19. So there will be an impact on lease liability. The change in lease liability, you can directly take it to your profit and loss. You will not be able to, you need not modify the ROU asset. So two relaxations. First one is follow the old discount rate. Don't follow the discount rate on the date of modification. At the same time, you can take the change in lease liability on account of this modification, on account of COVID-19, only to the P&L. You need not modify the asset. Is it mandatory to take the practical expedient? No. If you want, you can follow the regular lease modification approaches also. Finally, the amendment came in 24th July. So those entities which had already prepared and signed off their balance sheets for 1920, they can apply it on in 2020-21 with a corresponding restatement of 2019-20. So this is for those whose accounts finalized, those whose accounts were finalized before 24 July 2020. For those whose accounts were not finalized, they can apply it right from 2019-20 only. Okay, so that is about COVID-19 pandemic amendment. So now what I will share with you is an Excel file. This amendment, I will share with you a couple of notes and 2 or 3 problems in an Excel sheet. My sincere advice is to please take up revise this standard. I know it has been particularly hard today. I'm sorry for that, for extending for so long. But my thing is, I had to complete it today. Okay, so that is something. So this is my contact number. In case any of you wishes to reach out to me for any query that you have, you can definitely reach out. I'm available. I know the standard has been hard. If you have any doubts relating to this, immediately I will address it. Okay, so that your clarity is solved. And then coming back to Srinidhi's question, how can you revise this standard? Well, you will have to revise this standard, basically the computation part, which is what we did today. Okay, the remaining portions is largely theory, which you will just have to brush through for your exams. But modifications, reassessments, and sale and leaseback, sublease, these are all the topics which are extremely important, which we have hurried today, unfortunately. I'll share the Excel sheet, but go through it. If you have any doubts, I'm always available. Okay, so with that, I think we should wind up today's session. Okay, anybody has any doubts? Anybody has any doubts? Practical, I can think only what we have done today is going to come. Okay, nothing else. All right. You will have to make some, you follow my presentation. My presentation covers quite a number of things in simplified format. I have already shared the presentation. It should be uploaded on the BOS portal. Okay, so just go through that, please. And that should kind of take care of the standard. Okay, so with that, any queries or anything is left, please let me know. Any queries or anything left out, please let me know so that I can address. If there is nothing, I think it's mentally taxing for all of us here. So we should conclude it. No more queries are flowing in. I agree it has been hard. So please do it, and I will share with you the Excel sheet today or latest by tomorrow. Okay, so you should be in a position to revise what I have done, and I am reachable. Okay, I am reachable always. Okay, so thank you everyone, and see you guys on, I think, 12th of April, where we take up a new standard that is earnings per share. Okay, so thank you everyone.